in its contest with China rather than on attacking its adversary. Summers tells Bloomberg the U.S. should instead concentrate on its own innovation, infrastructure, education, and challenges such as opioid deaths. 7 national football teams, including England, will not wear a rainbow armband showing solidarity with LGBTQ rights, bowing to pressure from FIFA because players might receive a yellow card for the show of support. Qatar is under intense scrutiny leading up to the World Cup over the treatment of migrant workers, as well as concerns about human rights and its criminalization of homosexuality. And it wasn't the star the hosts were hoping for on the pitch, beaten 2-0 by Ecuador in the opening match. Today, the U.S. takes on Wales. And American musician Ye has returned to Twitter after a 2-week hiatus from the social network. And new owner Elon Musk welcomed him back on the platform. Ye's account had been temporarily suspended and restored at the end of October, which Musk said was not his decision. Ye's earlier suspension had been due to an anti-Semitic tweet. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
You do not get stronger that moment that you're lifting the barbell. You get stronger as your body is making repairs, making recovery. Recovery is a when and how you get fitter, faster, stronger.
Recovery technology includes everything from massage guns and foam rollers to compression boots, hyperbaric chambers, cryo chambers, infrared saunas, and even infrared pajamas. And athletes are partnering to become investors to take those products mainstream.
When you look at tech in sports right now, it's completely innovating the way training's going, completely changing the way recovery's going. I think sky's the limit as far as where it can go.
But while some of these products can feel amazing, it can be difficult to differentiate between what really helps the body and what just tricks the mind.
Every time you're chasing the latest, greatest, newest tool, you're probably chasing a mirage.
The single most damaging factor for the world economy is the war. And if we want to return to growth, the sooner the war ends, the better.
Kristalina Georgieva of the International Monetary Fund, on her war, again, from Eastern Europe. She viscerally understands the terrain. And Lisa Abramowitz, the terrain there this weekend was finally the feeling of winter. In some of the cities with destroyed infrastructure, the Ukrainians are simply pulling out people because they cannot live in that nascent winter cold.
And a real attack right now on the electric system, on the electric grid by Russia on Ukraine. How much is this really causing an escalation that's really creating a bit of discomfort and even more discomfort around the world?
Very good. Right now, we're going to stop the show. And we made a decision here at least 15 years ago to say, yes, we do economics, finance, and investment. But far more, we do international relations, not knowing the world would be turned upside down, as we have seen in the recent decades. Providing leadership worldwide on that has been Richard Haass. He's president of the Council on Foreign Relations. Full disclosure, I'm a member when I pay my dues. I think I'm behind on my dues, Richard Haass, but we'll go there another time. He is
the Bitcoin payment was really
the Bitcoin worked out. Richard Haass is retiring, pulling away from truly his Council on Foreign Relations. Richard Haass, thank you so much for joining us. So much to talk about today. Where must the Council on Foreign Relations go to lead as fractious international diplomacy?
Well, Tom, first of all, I'm not retiring from anything. I'm departing the council after 20 years, but I'm going to stay active in the public conversation, both about this country's role in the world as well as about the future of American democracy. But I think it's healthy for institutions, despite what's going on at Disney. I think it's kind of healthy for institutions every now and then to have a change in leadership. I think for the council, it's simply to continue to be a resource on a wide range of challenges, whether it's the revival of geopolitics, or global issues. We're just finishing up the COP27 meeting in Sharm el-Sheikh, and quite honestly, I think it's almost a complete and utter failure. And I also think increasingly we need to look at the relationship between America internally and America externally, and whether we're ever going to be positioned to again lead the world, because this world is not going to organize itself to meet the challenges it faces without an involved and effective United States. So I think the inbox in this field is as full as it's ever been.
I agree with that strongly. And folks, a brief here, 240 pages, is Richard Haass. The Bill of Obligations as he and we go in search of the will of America to move forward. Richard Haass, the new administration, the new Congress, the new presidency 2 years out, do they have the will to find their bill of obligations?
I don't see a lot of it, Tom. I'll be honest. I don't think we're off to a great start. The new Republican House of Representatives seems much more interested in politics than policy, in investigations than legislation. I think for the next 2 years, it's going to be extraordinarily difficult for the Biden administration to get legislation passed really about anything. I think you're going to see, therefore, an emphasis on foreign policy, where presidents traditionally have more discretion than they do on things domestic, and probably a greater emphasis on regulation, on executive action, again, to essentially find ways to do things without requiring Congress to join.
In this fractious global order, how confident are you that the U.S. will remain close to Europe, at least as close to Europe as they have traditionally, based on some of the recent fissures, not only with respect to exactly how to deal with the energy crisis, but also with tech investments and some of the bills that Congress has passed so far that really focus on the U.S.?
It's a good question, Lisa. I think it's a mixed record. On one hand, if this administration, the Biden administration, stands for anything, and it's an alliance-first foreign policy, and I think the entire management of the Ukraine crisis, the Russian crisis, has been pretty good. You also see a growth in transatlantic trade, whether because of energy or a de-emphasis on trading with adversaries, a re-emphasis on trading with friends. Where I'm worried about over the long term is not so much Russia as it is China. And I think there could be a growing split between what you might call American economic pressure on China, almost economic warfare, and Europe, led by Germany, looking to China in many ways to compensate for the loss of economic ties with Russia. And if there were to ever be a crisis over Taiwan, this divergence across the Atlantic, one makes a crisis more likely because China may not fear sanctions. Or if there were a crisis and the United States wanted to introduce sanctions, I could imagine a big transatlantic split.
This is really important, especially as German Chancellor Olaf Scholz just went to China with a bunch of executives of big industrial companies. How much do you give credence then to the softening in tone that we've heard, at least recently, with the U.S. and China and Tony Blinken heading over there early next year?
Look, I think it's good. I'm an old-fashioned diplomat, so I actually happen to believe in diplomacy. I think that's progress. I thought the meeting in Bali was a useful exchange. I think it's useful to have follow-up, but let's not kid ourselves. These countries are on very different pages. The question is whether they can set up some rules of the road about how to limit their differences over Taiwan so it doesn't lead to conflict. But I don't see any sign, for example, that China is lending a hand to deal with North Korea, which is busy building up nuclear weapons and shooting off missiles. I don't see that China is helping with Iran. We can go around the world. So geopolitically, the two countries are not on the same page. China's still not helping with climate much. So, again, to me, the real question with the United States and China with these talks is whether they can avoid negatives more than achieve positives.
Richard Haas, I grew up with part of the House being a middle 20th century isolationist, what was called a Chicago Tribune Midwest isolationism, something I'm sure you saw west of Oberlin, Ohio. And when I look at where we are today, Richard Haas, we have a new isolationism. It's always there, but this time it's different. Color the character of America's new isolationism.
Right, we're seeing it, Tom, and it doesn't respect party lines. We're seeing it in both the Republican Party and the Democratic Party. You see in the Republican Party a kind of flirtation with Russia, this talk about conditioning or limiting aid to Ukraine. On the progressive side of the Democratic Party, again, an impatience over money spent for foreign policy or national security abroad, wanting to see more at home. What's missing on both sides of the aisle is an appreciation of two things. One is that money spent on foreign policy is good for us here at home. We are not going to do well in a world that unravels, to use my favorite word, in a world in disarray. Secondly, what ails us at home for the most part is not a lack of resources being spent. You look at how much we're spending domestically. That's not the problem. It's how we spend money is the issue, much more than how much we spend. Plus, increasingly, as you know better than anybody, what's crowding out a lot of useful forms of domestic spending is not national security. It's servicing our debt. And that's something, if people on the left and the right wanted to free up money to devote to domestic causes, they could focus very much on the size of America's debt.
Richard Haas, thank you so much. With the Council and his Council on Foreign Relations, the new book, The Bill of Obligations, is the will out there to move forward into the next decade. We're going to move forward to a data check. Futures negative 22. The VIX back above 24. Monday, Thanksgiving week. It's a churn. It's an elevation. Stay with us. This is Bloomberg.
So is there more pressure when you're trying to win a basketball championship than when you're trying to please investors? Where's the greater pressure?
Oh, I think it's definitely trying to win a championship. It's hard because a lot of, like when you invest, and you know this, when you're investing, you can control a lot more things. When, you know, on a basketball court, you can't control whether somebody's going to make a shot. You've got to get lucky.
And what's the greater pleasure, making 5 times your money on a distressed debt investment or winning the NBA championship?
They're both fabulous. I wish I could do one each year. That would be great. But I think there's a great feeling in being right on an investment that you've done a tremendous amount of work and you've made money for your clients, which I think is great. I think winning a championship it's a very surreal feeling because there's a whole city or state that is actually behind you. You know, we had 70,000 people at the finals, and we had them all outside. You had 17,000 in the stands, and then literally like 60,000 people outside. And when we won, like just the joy that you had brought to the city was phenomenal.
The top names in climate change are on Bloomberg.
Building out local wind, local solar, hydrogen, these are solutions to not just climate issues, but geopolitical issues. We are in a position by 2030 to have 80% of all electricity generated by wind.
Renewables are the safest, the cleanest, and the cheapest form of energy today, especially for countries such as Greece.
Nobody covers climate change like Bloomberg, your global business authority.
We're in the early stages of a sustainability revolution that has the magnitude of the Industrial Revolution coupled with the speed of the digital revolution.
Nobody covers climate change like Bloomberg, your global business authority.
This economy is still the most resilient economy in the world.
The rally could continue. I do think it is a bear market rally. I mean, you know, it could go to the end of the year.
There are huge opportunities underneath the surface.
We're still going to be facing an awful lot of volatility in 2023.
Really what we're dealing here is potentially with an earnings decline that is not yet priced into the market for 2023.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene on a Monday on radio, on television, in 1 hour. England, Iran. John Farrow's not in today. I'm shocked, Lisa.
I wonder why.
I wonder why.
Assignment. Yeah, not only that, but you know how he was putting up his tree ahead of Thanksgiving?
Yeah.
Well, guess what? So did Bloomberg. So you've got the tree and you've got the World Cup, and he's off.
Yeah, well, you know, he's killing it here on Thanksgiving week. We hope John enjoys his World Cup. We do miss him because of his really true knowledge of all that's going on here. Qatar, Ecuador, you saw it yesterday. I saw it. It was pretty cool.
Yeah, it was cool, although Qatar is sort of sad for them because this is their real tour de force. I mean, this is when their country really put all the money into it, and then they just couldn't really make it.
You know, but that's my take is there it is, and the people committed to this, like Mr. Farrow with encyclopedic knowledge, they're going to love it, and we have to sort of follow along with respect. And it's in America the next time around.
You didn't say it was a massive week ahead.
No, it's not a massive week ahead. It's Thanksgiving week, folks. We talked to Margie Patel about her distressed bird she's cooking. Futures negative 22. You know, I look at it, and I think it's such an odd week. It's good to have the news flow of the morning. Let's go through the 2 items right now. Iger back in at Disney. Were you surprised?
I am not surprised given the fact that the shares have absolutely plummeted, that Disney Plus is losing more than $1 billion a year. You're seeing this real push from activists to do something, bring back somebody who could really generate a culture that was successful. But this was someone who really pioneered a lot of the streaming and really tried to push for a lot of streaming. What are they going to do? Offload ESPN? Is that what they're thinking of doing?
My take on this is the Sunset Tower Hotel in Hollywood and their wonderful poolside restaurant where people like Mr. Iger hold court. This is about creative people Mr. Chapek was not a creative person. Even he admitted that. And with all that's going on, particularly as Paul Sweeney says, in the streaming death we're seeing right now, get Iger back creative before they find a new creative person.
This is a specific industry, and yet wholesale, Disney is not the only one that's facing some of the worst losses in their history, and they're down the most now, going back to the 1970s, are poised for the worst annual loss. How much are you going to see more of this, kind of pushing for activism, for changes in the C-suite? Because that's really also what's underpinning this. You have Nelson Peltz coming in there, trying to push for change. You've got other activist investors saying, it's not working, you need to prioritize us, and it's going to get rougher ahead. How much is this going to end up being what's going to happen at a number of different companies going forward?
Yeah, it's going to be interesting to see. On China, let's get right to it. Endicur, and really I thought was informative there in the last hour. This is for real. It's a new lockdown.
Well, and this is because you're actually seeing cases spread. This is sort of the carrot and stick approach of reopening in China. They don't have the collective immunity. And you asked the good question to Endicur about what about Pfizer? What about Moderna? When are they going to start importing more effective vaccines? And we don't know.
No, I mean, it's just we don't know. It's all there is to it. Let's do this. We've got such a wonderful guest here. Let's get to the data right away and then dash to your brief. Futures negative 22 where they've been all morning. Bonds give us no information this morning. There is some economic data this week. And, of course, we stagger around to that critical inflation report that we see in December. And the jobs report, more important now than maybe 2 weeks ago. 2-cent spread gives me next to nothing, negative 70 basis points. I think oil's important. Lisa, to have oil crack would be really important. We're not there yet. West Texas, just under $80 a barrel.
Yeah, but this is on potential weakness, not only with respect to China and potential lockdowns, but also just globally as you start to see yields rise. By the way, it's countdown to meeting minutes on Wednesday, the FOMC meeting minutes.
Killing me. They put them out on Wednesday to bury him in the Thanksgiving accent. I do want to point out, and I can't cite it, I'm so sorry, but someone who is themed to be the takeover at the Bank of Japan made clear he wasn't thrilled about yield curve control. And yen out 1% today, two big figures, 142 rounded up is a weaker yen, and I think that's important.
Oh, that's
but
fascinating.
it's the radar, but it's important.
We'll keep track of that throughout the day. Also, what I'm looking at for today is Fed Speak. We have one. San Francisco Fed President Mary Daly is going to be speaking for almost 2 hours, starting at 12 p.m. Eastern. How much is she going to talk about the auctions? Because we're all focused on the 5-year auction at 1 p.m. today. But we also want to hear from her about how long she sees the Fed keeping rates potentially above 5%, when she starts to feel that perhaps they need to ease or pivot into a less restrictive stance. Today, earnings include Zoom Video Communications aftermarket. We were talking about Disney. How much do you start to see a complete rethink of companies that were completely bid up during the pandemic, completely bid up in an era?
Are you equating Disney with Zoom? I don't think you can do that.
There is only the similarity that they both ballooned in eras where suddenly people were rethinking the whole era of work versus home, of entertainment versus external experiences. So this is sort of a question mark. What do you do facing the new reality? And today, this is all that people really care about, the World Cup. Games include England versus Iran in about an hour time, Senegal versus Netherlands at 11 a.m., U.S. versus Wales at 2 p.m.
I'm looking forward to that. I'm looking forward to USA Wales.
I am as well, and I promise you that we will leave it to
what
experts
I'm talking about, but hey.
rather than us to try to pretend.
We should get David Blanchflower on tomorrow. I'm sure he'll be watching.
I'm sure everyone's watching instead of this and not going to be really looking for my insights in it. But nonetheless, it is going to be compelling to see some of the diplomatic kind of aspects of it.
Gabe, thank you so much for watching in Hollywood in the early Hollywood morning. Gabe makes very clear that Mr. Iger wouldn't be seen in the restaurant of the Sunset Tower Hotel. He would be in the Tower Bar. That's a surveillance correction.
Well, thanks,
Thank you, Gabe, for pointing that out this morning. Right now, and if you're taking notes on the equity market, get out the pad, get out the paper, because Katie Kaminsky, Chief Research Strategist at Alpha Simplex, is a turtle. She is a turtle trader from way back, which is trend matters. Katie, everybody would kill for your performance this year, still up 40%. What is the trend forward, or are trends breaking now?
Yeah, Tom, it's been a phenomenal year for trend, in a year where things are very uncertain. What we have noticed, though, is that we're going through an inflection point right now, like we saw earlier this summer. We're starting to see that shorter-term signals and longer-term signals are kind of at odds. And so I think we, just like the rest of the market, are looking for a pivot to the next big trend. So far, you're looking at a day like today, the dollar is coming back a little bit. That may not be over. And of course, short bond signals are still there in the data.
Well, Katie, can you elaborate on that, this sort of pivot point that you see in terms of short-term and longer-term signals? What is that pivoting us to, right? We've come from an era where bonds have been all over the place, but we saw a rally recently. We saw stocks being, both stocks and bonds rallying. What's the new pivot? What's that new reality?
Well, the thing is, the challenge has been that we've had a mixed signal. So there's no clear signal net at this point. And that's why I say we're definitely at an inflection point. But if I had to look a little closer at what has changed the most, optimism has come into signals at a level that is consistent with what we've seen recently. So you've seen more positive signals in equities, especially around the CPI print. You're also seeing a little bit more reversion out of the dollar trade, but that's still there. So that's why I kind of said it's a balance between what do we see shorter term and longer term. And the longer term signals are still definitely saying that there's some things to worry about ahead, especially the curve, the yield curve being inverted recently.
Katie, you've nailed it with bonds in particular. You went short bonds, which has been the widowmaker for so many years. And this was one of the areas where you absolutely knocked it out of the park with nearly 40% returns so far this year. How much do you buy this conviction that we're feeling in Wall Street, that that's going to be the biggest area of outperformance by 10-year, by 30-year treasuries, and you're going to just do really well next year?
So we did some research this year on bonds. It was called the short of shorting bonds. And one of the things that we need to think about if we're moving into a much more focused on rising rates and higher rates environment is that bonds are not going to behave under inflationary pressures like they did in the past. And this year was just the first data point to show us that that's the case. And I think what has been the most fascinating to me is how we avoid thinking about long bias. And so many of us are so dependent on being long bonds, we forgot what it's like to actually think about how do you deal with actually shorting bonds and how do you deal with bonds and valuation versus inflation. And I think that is going to be the key question for all investors in the next few years.
What's great about trend following, folks, and this is rumored, folks, Liverpool may be up for sale. John Henry, owner of the Red Sox, arch turtle trader. Rumor has it Henry may sell Liverpool to Kaminsky. We'll have to see on that as well. We get a lot of emails, Katie, when you're on with us. Are moving averages helpful to trend followers?
Yes, I mean, I think the way we think about it, moving averages give you one way to measure the strength of a trend. These days, we use a wide range of different methods. Some of it is based on machine learning. Some of it is based on different types of breakout signals. But the point is, in environments where the world is very uncertain, you have to turn to what the market is doing as opposed to what it should do. Because frankly, few people actually know what it should do these days because it's so volatile and unclear what the future is actually going to hold under this inflationary environment.
Katie, thank you so much. Katie Kaminsky, arguably the #1 performance of surveillance guest this year at Alpha Simplex is, well, it's just stunning to me to see, Lisa, how trend following versus gaming, catching a knife in the dark, how trend following, there's some years where it just clicks in with a vengeance, and this was one of them.
Turtles?
Turtles, this goes back to the 70s, I think. Two guys wrote a book or a paper even, and they called it turtle trading because of the patience required. And it started out pretty much with CTAs, and the C is for commodities, because as a general rule, commodities trend more than the other asset classes. You climb on cocoa and you stay on cocoa.
I'm just
you climb
so
on
glad.
Tang futures.
And you just stay on Tang futures forevermore. That's what we do.
Put the kids through school.
On Tang futures. Thanks.
Stay with us. Futures at -23. Dow futures at -89. This is Bloomberg. Good morning.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Chinese stocks and the yuan retreated as a string of reported COVID deaths and tighter restrictions in some districts gave investors a rude reminder the path to any reopening will be rough. A city near Beijing that was rumored to be a test case for removing virus restrictions across China has asked residents to stay at home for 5 days, a potential sign officials are reverting to tighter COVID-0 curbs. Meanwhile, the country's first COVID-related death in almost 6 months has sparked concern that Beijing could see a return of restrictions. The U.S. and Chinese defense chiefs are likely to meet for their first talk since Beijing suspended dialogue with Washington over House Speaker Nancy Pelosi's August visit to Taiwan. A Pentagon spokesman says U.S. Defense Secretary Lloyd Austin would welcome a meeting with Chinese Defense Minister Wei Fenghe. Now, it's the latest sign that ties between the two nations are stabilizing. The COP talks in Egypt have ended with an agreement to help developing nations face the devastation of climate change. Although the deal for a loss and damage fund paid for by rich countries is seen as a breakthrough, negotiators failed to agree further cuts in CO2 emissions. Equity investors hoping for a better year in 2023 will be disappointed, according to strategists at Goldman Sachs Group, who say the bear market phase is not over yet. Strategists including Peter Oppenheimer and Sharon Bell predict markets will reach a final trough next year before a strong rebound. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
We've invested more than $10 million in our employees over the past year, and we're going to continue to invest more. We're testing 4-day work weeks to help, especially our working parents kind of juggle that balance between childcare and your work. I know I deal with that all the time. This is really a people-first company. Even in an inflationary environment, you're going to see us continue to lead with our people.
Do you worry at all about a price wage spiral, not just here, but in the industry, in the economy?
Yes, and I think that this is something that many business leaders are focused on, and time will tell kind of how all of this lands.
I think the wage price spiral continues for quite some time, and I think we probably have been a lot less aggressive than we can be, and than many other companies have been.
In terms of raising prices?
Yes, we've taken our time. If you look at the 20-year history of pricing in this company, we've taken about 2% a year on average. We've never taken what we could. We've always taken what we should. We have to pay people more. We have been and will continue to do so. We'll take a little bit of a margin compression on that as we've had to, and I think that's the right thing so that for the long term, Shake Shack continues to be what we're building, which is the next generation's burger joint.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
A multi-trillion-dollar industry. There's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ. Monday on Bloomberg. Welcome to the world of decentralized finance.
I'm going to take a look right here at regulation.
We are seeing digital currencies under some pressure.
Bloomberg's covering all things crypto. The people.
I want to have some of my money outside of the sovereign.
The transactions.
It all comes down to the details here.
And the technology.
How does that affect disruptors like you?
What happens to everything that you're investing in when the last Bitcoin is mined?
Bloomberg Crypto, Tuesdays.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
The top names at the Fed are on Bloomberg.
I think it will probably be appropriate soon to move to a slower pace of increases, but we have additional work to do.
Nobody covers the Fed like Bloomberg.
There is more work to be done. I expect that this will require additional increases in the federal funds rate, followed by a period of holding rates at a sufficiently restrictive level for some time.
Susan Collins of Boston managing the message forward for the Fed. Mary Daly is a lonely speaker today, I believe. Lisa, Mary Daly is important. Susan Collins is important. Is everybody from the Fed speak you follow, is everybody on the same page?
I think so at this point. There is a feeling that you need to get restrictive, that inflation is the first and the foremost concern. Leah Brainerd, perhaps, has been the vice chair has been perhaps the most reluctant to go all in terms of how far the Fed has to go, in terms of how long they have to stay there. But it's pretty unanimous. Inflation is the number one concern, period, full stop.
Dr. Brainerd, having a cumulative Thanksgiving, it will be the accumulation of cooked onions, mashed potatoes, squash, creamed onions, yes. The cranberry sauce.
How do you do your potatoes?
How do I do potatoes? Someone else does them for me, thank you. Mashed potatoes.
Oh, okay.
But you know, I can go either way there. I mean, it's good. Anyways, there's the Fed speak today. We won't ask Mary Daly today what she's going to cook for Thanksgiving. I mean, Alex Webb doesn't celebrate Thanksgiving. He's in London and joins us now with Bloomberg. Quick take. In here, on the many happy thoughts, as Peter Pan said to Wendy, John, and I think it was Alex as well in Peter Pan, think happy thoughts. Alex, to begin, there are not happy thoughts today at Disney. There is repair. What does Mr. Iger have to repair?
Yeah, I mean, I think that what had happened during lockdown, and not to belabor the analogy too much, but there was second start of the right, carry on till morning. Well, morning has arrived, and actually what they were trying to do during the lockdowns was, under pressure from activist investors, they pivoted basically towards being a growth stock. They cut the dividend, they invested that in Disney Plus, in content for Disney Plus, with the hope that they would get close to the 50+ price to forward earnings multiple that Netflix was enjoying at the time. And that worked. It worked during the lockdowns. Of course, what we've now seen is that with rising interest rates, we've seen a flight away from growth stocks, and we've seen therefore Netflix shares come down, of course, exacerbated by its stagnating user growth, and Disney shares come down as well. Disney has reinstated the dividend, but it's still far lower than it was 3-4 years ago. So the question for Bob Iger is, like, do you take more capital away from Disney Plus, and do you then try to return some of that capital to investors, because returns are now what people, sort of more immediate returns, are what investors are looking for.
Alex, that's the financial here. I'm very fascinated by the creative side of which Mr. Iger excels. Is he simply a caretaker as they go out and find a new creative CEO?
Well, he clearly is a caretaker in the sense that he's been given a 2-year contract, and it's hard, given his age, to imagine that it would be extended much beyond that, even though we saw his contract extended time and again, before he ultimately handed over to Bob Chapek. Look, his approach to Disney was trying to stabilize earnings by investing in franchises. We saw that with Pixar, we saw that with Marvel, and we saw that with Star Wars. It was with Lucasfilm, where they built these franchises where you could pretty much be guaranteed you'd be getting an audience for their films. That helped stabilize revenue over a relatively long period. Now, the calculation's a little bit different as we look at the streaming world, where you need to have so much more content. It's not just tentpoles. You need a regular cadence. That is very capital intensive, and now the market is questioning whether that capital intensity is ever really likely to reward you with stable revenue.
How much is this a Disney story, Alex, and how much is this a broader story about right-sizing a company that really expanded during an era of free money and then a pandemic distortion around entertainment?
I think you're right that there is a broader piece here that lots of other companies, particularly, as we say, these kind of, in inverted commas, growth stocks have had to do a little bit of correction. There is a lot of Disney-specific stuff because there is an element with Bob Chapek that, yes, maybe he mismanaged some of the capital market stuff, but there is also internal culture stuff, some of his engagement with politicians, not least in Florida, which were not taken particularly well by the employees. If you've lost the investment community to an extent, and you've lost your employees, again, to an extent, then you can see why the board might sit there and go, well, actually, is this the right man for the job?
Who buys ESPN?
Well, ESPN is a cash cow for Disney, right? It doesn't really make sense for them to want to get rid of it. I'm sure there are plenty of people out there who would like to buy it. The signals we've seen pretty much without fail have been that Disney does not want to sell it. And you can see why. Think about it in terms of the New York Times. The New York Times might be pivoting toward digital, but for much of the past 5 years, it's still made very good money from ads in its print business. So Disney has a similar approach. Yes, you might think that cable is a dying business or is in slow long-term decline, but it still remains highly profitable and generates a huge amount of cash.
Alex Webb, thank you so much. Got to go. See you on the second star on the right. Alex Webb there with our Peter Pan theology in London. And it's the only place you can do Peter Pan. I mean, how many times have you seen Hook, which was not on Disney? I mean, Hook was on TriStar, but Dustin Hoffman, Robin Williams, how many times have you seen Hook?
How many times have you really watched Disney Plus?
I do. I just finished all of Andor. I actually liked it. It was actually almost successful.
Well, I wonder how much they can cater to adults because they're known as being the key babysitter for children, and now they have to sort of readjust, especially with Hulu.
Well, there's some enthusiasm out there. I know Doug Cass looking at Disney this morning and finding it attractive. I believe it's his third largest holding. And Jason Bazinet over at Citigroup reaffirms here, Lisa, 92 up to where I think right now it's roughly 99.73 and his price target 145. He says, Iger, there's going to be some theology here. Like, what does Disney do with sports betting? Well, and the answer is Iger's not so sure they want to do that.
Well, this is a culture question. I do just look at the shares. They're down 41%. Year to date.
Everything else is too.
Okay, but this is the question.
In Chapek's defense.
But this is the question. When do we bottom? Right? And that's really the issue. People are seeing this as an opportunity. Okay, now it's sort of reset in terms of the pricing. So when do we see the bottom? And that's the catharsis that we've been looking for that people are really talking about.
Paul Sweeney is on the same page as Michael Nathanson and Richard Greenfield. It's to show me a sustained profit model of streaming. And I just don't think it's there. And I don't see it.
And what about bundling, right? Who's going to be the bundler? Who's going to be someone who takes this and really offers it in a way that is comprehensive, that is organized, that is going to give people some sort of price realism? Because honestly, when you start to put them all together, it starts to be more than cable.
I mean, I don't know. I look at it like this weekend I was watching this Bombay thing on Apple TV. It's an Indian thing. They're in Bombay. Some Australian guy goes up to Bombay, and he's got a hideout in the slums and all that. Well, how do they make money at that? I mean, the actors are clearly overpaid. There's no question about it. But how do they make money at that?
I'm struggling to know where to go with this. A Bombay thing, and there are people going around, and how do they make money? Look, I think that your point is well taken, that they travel, that they're big budget, that they're big, productions. And then how do they generate the enthusiasm when it's all over the place in disparate places? But Netflix has turned it around more than people had expected. Can Disney do the same?
I don't know. We'll talk to the experts on this. Fascinating to see Mr. Iger back at Disney. Futures, the tape's not giving me much love today. Japanese yen, 142. Weaker yen, that's important. This is Bloomberg. Good morning.
When I started, I had no idea it was going to turn into this, which is a tracksuit empire. I don't have any investors. All this is all money in. This is me going out and hustling, bringing that money back, and just building it, building it, building it. You gotta think about a person that was homeless at one point, didn't really have any money coming in. The fact that this person was relentless and just determined to succeed and not let rock bottom define him as an individual. I can take things and put them together and take them apart and make them better and put them back together. I respect the craft, so I don't want to minimize and disrespect the value of each step of the craft and do by machine what should be done by hand.
A lot's happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights
A lot of these areas still have very, very good valuations.
from businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot. We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
Bloomberg Surveillance. Jonathan Farrow, Lisa Bramwitz, and Tom Keene. John Farrow off on assignment. England, Iran here in 30 minutes as well. And I need to say thank you to all of you out in the zeitgeist who have been very supportive of how we address Bitcoin. Lisa, I'll be honest, in hindsight, it's easy, but if none of this blow up had happened, I still would say it. We've killed ourselves trying to be balanced on this.
And to try to not buy into the incredible enthusiasm at a time when a lot of people didn't understand it, but we're still investing in it.
Yeah. Well, we'll have to see. What we're going to do here is talk to two experts on Bitcoin. But first, we've got to look at a non-mover market with futures negative 20. What do you do? Start with Disney and stay on
basically,
Disney?
we're just going to do real quick. Disney shares up after people looking at what's going to happen with perhaps a new leadership. I'm looking right now at a pop of 8.5%. I'm also looking at some losers, Las Vegas Sands and Wynn Resorts, and this really is on the prospect of perhaps renewed shutdowns in China, and it really shows how much the entire entertainment business hinges to some degree on what happens there in China. That's it. I'm not going to sit on this because this is a market in stasis ahead of the bird.
Bitcoin. Yeah, that's what we're going to do here. You'll see it Monday, Tuesday, Wednesday. Rumor has it Bramo in Thursday as well. John and I will be on our way to Doha.
Thanks. I appreciate it. Anytime.
With Damien Cesar. That's cool.
That is cool. We're going to have a great time.
Very cool. Bitcoin. I'm going to start with Katie Greifeld. Of course, she has been outstanding in giving us coverage. Katie, if I was teaching a lecture on point and figure charting, Bitcoin from 61,000 down to 16,000 is one of the ugliest charts I've ever seen. Today we dip under 16,000 to 15,000. Does anybody care about that price action?
I would say so. Again, that $16,000 level, for better or worse, it's really held. We did get
I thought 20 was where we were going to held.
Well, we're talking about round-ish numbers, even numbers. You say the chart is ugly. I think in a way it's kind of beautiful. I mean, if you look at it over 1 year, you get these plateaus, these drops, drops, which, I mean, you don't really see that in other assets.
So in this beautiful chart that you're looking at, why have we not seen a bigger drop if $3 billion were wiped out for creditors with FTX?
And we don't know who they are.
And we don't know who they are, and we don't have a sense of what the ripple effects will be.
Well, to start, it's a market that's controlled by a lot of whales.
Keep going.
The Grayscale Bitcoin Trust, for example, that alone, it's a $10 billion trust.
Greyscale Bitcoin Trust?
Grayscale.
Oh, excuse me.
A lot
You
of
didn't
G's.
tell us.
Yeah, can you imagine if I revealed myself? But in any case, that controls 3.3% of the outstanding supply of Bitcoin. You have a lot of large holders such as that. And at this point, too, the fact that we're at $16,000 from $69,000, a lot of the sellers who would be selling, the marginal seller, they're gone. They've already been flushed out. Now you're left with the true believers who losses aren't real.
Seriously, who are they? I mean, is a judge going to come out and say you have to show who they are? I mean, what's our reporting on this?
Well, there's a difference between someone who is now a creditor at FTX, a customer who lost money, and people who keep their Bitcoin, for example, in cold storage off these sort of hot wallets, who have them really stored on the blockchain.
What does cold storage mean, Tom?
It means that Jenny, cold storage is when you're on Keuka Lake ice fishing and you put the case of Jenny cream in the ice.
Specifically to Bitcoin, it means that you don't actually hold your Bitcoin at an exchange. You don't trust these centralized exchanges, and you don't want to be a bag holder.
Katie Grunfeld, thank you so much. No, but it's honestly, this is a really interesting question, and people have been asking this, Tom, for a long time, or at least for the past couple of weeks. Why have we not seen more fallout, especially in such a jittery market? Peter Scheer has been writing a lot about that, head of macro strategy at Academy Securities, and we're so glad you're actually in studio with us, which is fabulous. It is wonderful to have you on this pre-Thanksgiving week. Peter, how much are you seeing some sort of, I don't know, whales, and how much are you seeing something where it's a realistic pricing action of institutions having fully adopted a crypto asset, even if it does lose favor to some degree?
I think we have one more big leg down in crypto. I think we're going to see some selling off in Bitcoin. I think one of the things that supported it recently are the fact that there are a lot of whales who have an invested interest in keeping it higher. And there's all this talk about Bitcoin maximalists, right? So there is a theory that, okay, FTT, the tokens, that was where a lot of the trouble was. Maybe Bitcoin's the quote-unquote safe part of crypto. I think that narrative is going to get hurt a little bit. And all the stuff that's been going on with the Grayscale Trust. So GBTC has been feeding into that a little bit. So people, I believe, have been selling that to buy Bitcoin. I think that's going to turn out to be a mistake as well.
Why isn't this a broader market story? How can this be so contained, given that this story really grew up in the era of free money?
So I think earlier this year, it's a great question, but I think earlier this year, they were kind of tied together because you had a lot of people who were invested in crypto, they were invested in disruptive stocks, they all were doing it on margin. So every time one sneezed, it would, drag down everything else. That got shaken out a little bit, so we're better off right now. I think the next leg of this is going to be, wow, what happens to the economy? You start looking at the amount of money that was being spent by even FTX on advertising, crypto as a whole, right? I think this is going to feed into the economy. I think the wealth effect is real, right? This time we've lost $3 trillion down to just under $1 trillion, right? There's been huge wealth effects. I think this is going to bleed into the economy. Generally, that's going to be bad. I think it's going to turn out to be good for energy usage, though.
Peter, thanks so much for coming in. You have an August firm, hugely conservative at Academy of Securities, of former admirals and the like as well. They hang on every bit of when Scheer publishes on rates, risk, and Taylor Swift. How'd that sell?
We got to do some clickbait too, even in our part of the business.
Well, how do you sell Bitcoin to a conservative shop like Academy? These people are going to say it's unregulated, it can't be regulated, it's foreign. How do you sell Bitcoin as a legit thing to a bunch of conservative people at Academy?
So fortunately, I've been fairly negative on it, but I think we're having these conversations. Where do we step in? When does it get interesting for our firm to explore it? It's really going to come down to regulation. Do the regulators come out and create an environment that you can feel comfortable with, right? And right now, it's just not there. One of my big takeaways has been for the last year to talk something as simple as where's something domiciled and where are
exactly.
their,
okay,
and where's
you
their
were right.
CEO?
You and I are on the same page on this. Alibaba's hanging out at the Cayman Islands trying to play by a different rule book. I'm going to defend Gary Gensler here right now. What does he regulate? Where's the domicile?
I think that's really the key issue, right? You've got to have some sort of domicile here. And the big question I think a lot of people are talking about, even whether it's these Grayscale trusts, is where is the Bitcoins? We talk about spot ETFs, blah, 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 right? It's like, how do you confirm on a daily basis that what you think you hold in the crypto world is legitimately there without maybe publishing it and exposing yourself to theft or hacking? So I think that's really the key is most other assets, you understand whether you own it, whether it's an equity, whether it's gold, you can pretty easily prove it. That's been the hard part with crypto. I think that's what's going to have to get to the heart of regulation is how do we verify this? How do we get comfortable that we are auditing something and regulating something that's actually there?
Neil Kashkari has been talking about how this is just a Ponzi scheme. He doesn't really think that there's any there here, and he's been very vocal about that on Twitter and in lectures. How much is the banking industry leveraged to the Bitcoin and frankly to the crypto story, not necessarily by borrowing money to invest in crypto, but in building up teams of people designed to trade it, designed to invest in?
I don't think the banks have really put that much effort into it. I think they're building out, but it's a small part of their business. The other part of this, I do think people made a mistake, is every time some bank announced they were doing something on crypto, everyone read, oh, this is great, they're adopting it, they're adopting it. No, banks are very smart, right? If there's bid offer to be made, if there's some trading revenue to be made, they're going to get involved. That's not a commitment to it. So I think banks can pull back if this doesn't work out. And to me, Bitcoin is always about adoption, the rate of adoption. When you want to get bullish on it, you see adoption coming up. I just don't see it going up anytime soon. In fact, I see it dropping as more and more people question why they want to be in this space.
What's your call for 2023? Let's get out front of your year ahead report. You get Taylor Swift into it?
I'm not sure about that. I think crypto going down will be sub 10,000 on Bitcoin.
You're calling sub 10,000 on Bitcoin?
Definitely. I think that actually potentially happens even this year. I like rates, though. I think yields are actually probably the easiest trade. I want to be long yields right now. I think treasuries are going to rally. I think the economy's rolling over. The data's rolling over. And as hawkish as the Fed wants to talk, the markets are starting not to listen to it. So I love owning bonds here.
Well, but we were talking to Carl Weinberg earlier, and he says quantitative tightening. What about quantitative tightening?
So to me, quantitative tightening is a little bit the opposite of quantitative easing, in fact, almost the exact opposite. And I find quantitative easing easier to explain. It's like if you have these Newton cradle, right, where you drop this one ball and stuff shoots out at the end. So that's what happened. It shoots out, and where it really exposes itself at the riskiest end of the spectrum, right? So every single person winds up having to make a choice. I have to either buy longer duration assets, riskier assets, less liquid assets, and it really comes out at the far end. That's why I think crypto did so well, all these disruptive stocks. So when it comes back in, it's not going to express itself in yields. It's going to be in the riskiest assets. So I think stocks can still lag from here, and it's not going to express itself regardless of what we're doing on the quantitative tightening in the bond market.
Bonds price up, yield down, stocks don't play.
No, I think not. I think maybe we get a little surge in stocks after we get through this crypto debacle where people get back to comfortable, oh, lower yields is good for stocks. Then I think the reality is going to be, no, yields are going lower because the economy has rolled over. We've done too much. We have these problems. And quantitative tightening, I think, is more impactful on equities and risk assets than bonds.
I mean, Evermore came out, Taylor Swift with Jack Antonoff and the National. I mean, what they did, Peter, during the pandemic, she just said, I'm not laying low for the pandemic. And they just created and created and created. Look at the payoff.
No, it's been phenomenal. I think one question that's been coming up directly to our business is, what does this do for M&A activity, right? We've already had DC that doesn't like M&A activity, and now all of a sudden you've got Live Nation, these companies, getting reported on. I think it's going to be interesting, and I think that's going to be a headwind for M&A next year.
Were you really prepared to talk about Taylor Swift? Is that really what we're doing here?
Yeah. I wasn't that prepared, but I figured,
I think
Tom, you got to be ready for anything.
I think the influence of the National on what she did here acoustically was stunning. I mean, Antonoff's my hero, but,
I'm not an expert in Taylor Swift. I will say that the controversy over some of the ticket sales is going to be something that...
Her song Illicit Affairs, the moment I heard it, boom. Timeless.
Are you a Taylor Swift fan?
No, I'm not actually.
Okay.
Peter Chair, thank you so much with Academy Securities Futures. Lisa, do the data. You can do the data check better than me here.
All right.
It's like, Turkish lira. Turkish lira, 18.63.
Tom's like, please tell a story because there's nothing happening. Well, their NASDAQ is down 0.8%, and that's interesting. The yen is fascinating.
Dollar stronger, yen weaker today. That's a backstory for this holiday lengthened work week. Please stay with us again. This is Bloomberg Surveillance.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. In Indonesia, at least 46 people are dead and about 700 others injured after a 5.6 magnitude earthquake shook the western Java region today. Several homes, stores, and public buildings are damaged, and landslides are reported following the roughly 7-second earthquake. Tremors were felt in nearby cities, including the capital, Jakarta. In a newspaper interview, Germany's defense minister says the country is offering Patriot missile defense systems to Poland. Last week, a strike killed 2 people in a Polish village near the Ukrainian border. Germany also intends to extend a deployment of Patriot batteries in Slovakia through 2023. The UN's atomic agency says powerful blasts shook the area of Ukraine's Zaporizhzhia nuclear power plant over the weekend. Former Treasury Secretary Lawrence Summers warned U.S. policymakers to focus on building the country's own economic strengths in its contest with China rather than non-attacking its adversary.
We in the United States probably need to be careful about our evangelizing influence. I don't think it's really for us to tell China how they should organize their entire society.
Summers also cautioned about Washington becoming too aggressive with regard to strengthening ties with Taiwan, which Beijing regards as part of its territory. And Twitter's head of France announced his departure. Damien Veil led the region for about 7 years. A number of workers at the Paris office, which had fewer than 50 employees before billionaire Elon Musk took over last month, are focused on advertiser relationships. Musk is considering additional layoffs and has already slashed Twitter's workforce in half. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts. I'm Lisa Mateo. This is Bloomberg.
And says, I want to be Ari Emanuel when I grow up. What should somebody do to get into the talent agency business or the business you're in?
Well, it's hopefully what I've taught my kids. You got to be intellectually curious. You got to be, you got to show up. And you know this like I know this. I got on a lot of planes. You just, even though that voice in your head is saying, oh God, I'm so tired, I don't want to do this. You got to show up. You got to be charmingly relentless. You have to build emotional endurance because there's no straight line to success. It's kind of all over the place, and you have to just be able to work through those things. And then I think one of the things that I do every week is I try to create serendipity.
No one covers the world like Bloomberg.
My team thinks 2023, we avoid a recession. I'm a little more skeptical about that.
China and the U.S. both do not want to see nuclear force on the European continent.
The regulators here in the Bahamas are ongoing with their investigation into FTX.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
We're in the early stages of a sustainability revolution that has the magnitude of the Industrial Revolution coupled with the speed of the digital revolution.
Nobody covers climate change like Bloomberg, your global business authority.
The question about is inflation peaked misplaced? Yeah, it probably has. The better question is it going to 2%? Or is it going to stop at 4%? Because if it stops at 4, then the Fed has not been too aggressive. I'm in the camp it's going to stop somewhere around 4 or 3.5, and that's the real problem. Not that we've peaked, but that we're not on our way back to 2%.
Jim Bianco there driving the conversation forward, and it's a huge debate about whether the Fed, with their interest rates. What's the consensus right now, Lisa? I don't really think I have one.
The only consensus light is that long duration bonds, just as Peter Shea was saying, are going to perform well next year. That seems to be a feeling, and that stocks are kind of going to meander, and that seems to be also another feeling, and that we're going to see peak dollar. There are some consensuses forming. I'm also seeing a lot of calls that China is going to outperform just based on how much pain has already been absorbed into certain valuations. So those are some of the themes that I keep hearing.
Moving the schedule around because of the World Cup, Lisa Abramowitz and Tom Keene, Jonathan Farrow is waiting for England-Iran here in 12 minutes. And Lisa, Friday, when you're with Damian Sassower, I didn't have the time up yet. Farrow hadn't sent me the time, but 2 p.m. Wall Street time, England, USA, and John has selected a bar to go have the beverage of our choice in as
Big
well.
game. I was laughing because I'm thinking, that Tom Keene and Lisa Abramowitz are going to lead the football coverage throughout, which really is, pretty much says it all, that side.
I think Mike's helicopter almost crashed. He was so upset by that. Saving us in Doha, Simone Foxman joins us right now outside the stadium, 30 miles north or so of Doha the other day. But today, within the skyscrapers of Doha, in our studio is, well, Simone, let me give you an open question after what we saw yesterday. How's it going for this global event?
Well, in the stadium, in Al Bayt Stadium yesterday, I think it went pretty well. Yeah, there were some growing pains. There was a lot of traffic from the cars getting there. That was one of the few stadiums not connected to the metro system. But it was a pretty impressive opening ceremony. Less impressive game. Ecuador easily defeating Qatar 2-0. But also impressive in the stands. We had the leaders of Turkey, of Egypt, and the Crown Prince Mohammed bin Salman, very closely chatting with Gianni Infantino, I might add.
Well, it's going to be interesting today, and I really go forward to tomorrow. Denmark, Tunisia, I think, is a game I'm speaking. Farrell, I took notes when Farrell called me today. France, Australia, maybe that's interesting. Where's the tension today in this first day where we really get started?
It's all about England, Iran, and that kicks off in just 10 minutes. Yeah, it does. It does. 4 p.m. local time. There are fans making their way into the stadium right now. But there is a lot of political drama on the pitch, off the pitch. For one, we saw just a couple hours ago, FIFA tell teams that captains could not wear rainbow-colored armbands. This was something that Harry Kane of England in particular, but also some other teams really wanted to do in support of LGBTQ rights, but now FIFA threatening sporting sanctions, the teams telling them don't do that. But also remember, massive demonstrations going on in Iran. We are very closely watching to see how the team reacts, because the team has traditionally been this hotbed of regime unity. But now a lot of Iranian fans say they don't want to celebrate given all the tragedy that they see just across the Persian Gulf.
Simone, what does this do for FIFA? Why is FIFA so insistent on cracking down on wearing armbands that support LGBTQ rights?
You know, they've been really supportive of Qatar the whole way through recently. We heard a pretty strong speech by FIFA President Gianni Infantino, essentially calling out Western criticism for being racist. He said he felt discriminated against as a guy with red hair and freckles living in a foreign country, and compared that to the experience of gays, Africans, and the like. It was a little bit bizarre, but you know, I think they really want to stand behind Qatar. They've invested so much in this experience. They don't want the country to kind of continue to face this. They are trying to encourage players to play football on the field and not, follow the recommendations of activists who are saying, hey, players, hey, teams, bring attention to these issues while you're there.
I've never been to Doha. Simone, is it bustling? I mean, what's the... is it like that walkway up towards the Tots Stadium where it's really bustling and all that? Is it bustling, or is it just so big that it's not bustling?
You know, Qatar, Doha is a pretty small place, but what surprised me is it hasn't been bustling. I was out at some of the fan zones, the fan areas yesterday, and there just were not a ton of people milling around. I'm going to go out there in just an hour or so and take a look once again, but you know, Qatar's worked really hard to try and limit the number of people who can come into the country. Right now, you can only come in if you're a ticket holder, if you're a registered guest of a ticket holder. And that to prevent too much pressure on some of the infrastructure. But wouldn't it be a terrible thing if, you know, by preventing so many people from coming, you ended up with, you know, not a fun World Cup?
Yeah, well, that's certainly was an issue at the end of the Ecuador versus Qatar game. I am wondering whether we're going to see Messi and Ronaldo face off. This has been one of the big questions, Argentina versus Portugal. The one thing that I do know is the legacy of these two superstars is going to be determined at this World Cup. What's the latest in terms of what the likelihood is that they'll get that
Channeling
matchup?
your inner John Farrow.
I don't know. You know, I have to say I'm not the best sports bettor, and my bracket is probably entirely wrong. But certainly there are lots of fans, particularly from Argentina. I've seen a lot of Argentinian fans. I've seen a lot of Brazilian fans. Seen a handful of Portuguese fans in town.
Right.
Certainly the Ecuadorian fans were out in full force last night.
Simone, thank you so much. In Doha through December 18th, and of course the World Cup. We'll have coverage on that for you as we can, particularly led by, I should say, John Farrell. Surveillance correction. It's good to do a correction.
Oh, we've done a couple
on a slow
of
Monday. Jim emails in and says, Tom, you stupid idiot, you remember the Turtle Book. We're talking to Katie Kaminsky.
Yeah.
And I said there was a Turtle Book, like everybody read it. And Jim says, wait, Richard Dennis did this years ago, and I remember this now. Thank you, Jim, for mentioning this. It was a course, I think in New York. It was a course. You went to Richard Dennis's trend following technical trading course, which became known as turtle trading.
All I know is
23 original people.
When you opened it, you said, "Here comes a turtle." I was like, "Oh, please don't hang up on us! Please don't hang up on us when you call her a turtle." And yet, that has been a point of pride for her this year.
Oh, yeah.
Because she has done absolutely phenomenally well. And you pointed out something really interesting, Tom. You said that this traditionally is to not lose as much money or to just do consistently well. And this year, it has been a blowout, bang-up year. And how much can that continue? And how much is that really just a sort of highlights the moment that we're in right now?
I'll defer to the pros on this, including Ms. Kaminsky, but to me, so much of trend following is not about making money. It's about avoiding losing money. It's a little bit different than the way so much of the media portrays it. My long Bitcoin at 40,000, that was turtle trading.
Yes, so was really, the long Austrian bond.
Oh no, we still have the Austrian. We're going to be buried with the Austrian bond.
Some serious turtling right over there. Oh, God.
David Riley, Chief Investment Strategist at Blue Bay Asset, on your next bond purchase. Bloomberg Surveillance, good morning.
a successful company, but you might not want to run it for the next 10, 15, 20 years, or do you? And if you didn't, would you want to go into government? If the president called you to serve our country, would you go into government, or would you start another company?
I love what I do. And I feel like I have this luxury with 23andMe that it keeps evolving. You know, we started out just as a consumer company. We're thick in research. We got into drug discovery in 2015, and now we're getting to the delivery of care. So I've been really lucky with 23andMe that it's been endlessly interesting. And I'm surrounded by incredibly talented, brilliant individuals where I learn from them. And what I always advise people to do is like you should take jobs where you're learning. And if you stop learning in a job, then you should quit. And like frankly, when people leave 23andMe, like I say, if you're not learning anymore, you should move on. So I'm 100% committed to 23andMe. That said, my other passion is other direct-to-consumer. Like, I want to build out a true consumer-empowered healthcare world, like one that is outside of the existing system. And there's no greater force than government.
A multi-trillion-dollar industry. There's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ. Monday on Bloomberg. The top names in climate change are on Bloomberg.
Building out local wind, local solar, hydrogen, these are solutions to not just climate issues, but geopolitical issues.
We are in a position by 2030 to have 80% of all electricity generated by wind.
Renewables are the safest, the cleanest, and the cheapest form of energy today, especially for countries such as Greece.
Nobody covers climate change like Bloomberg, your global business authority.
This economy is still the most resilient economy in the world.
The rally could continue. I do think it is a bear market rally. I mean, you know, it could go to the end of the year.
There are huge opportunities underneath the surface.
We're still going to be facing an awful lot of volatility in 2023.
Really what we're dealing here is potentially with an earnings decline that is not yet priced into the market for 2023.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
It is not a big week, not at all. It is Thanksgiving weekend, yet it is. This is Bloomberg Surveillance. Tom Keene, Lisa Abramowitz, and Jonathan Farrow. Jonathan Farrow off on a well-deserved day off. We are looking at a day ahead of this holiday-shortened week where there is a great reset. And right now, Tom, that is what I'm focused on, all of the year-ahead outlooks that speak of a new 2023 of a very different contract.
Trying to get those slipped out now. Some of them weighed in. To be fair to all the wonderful guests we have, they have to not front-run what their clients would see. There's some serious regulations over that, but we can see them here and there. Tony Dwyer, who's been hardcore 5, 10, 15 years linking recession to equity downturns, he calls recession.
Katie Kaminsky on earlier has been up almost 40% year to date, as you put really well, Tom, that she basically has been probably the best performing surveillance guest that we've had on regularly. How much has she been seeing a pivot, a new dynamic in the trend following space where suddenly the long-term and the short-term indicators are not sending some sort of consistent message? How much is that reflected in the outlooks, in the angst that we're feeling from Wall Street right now?
Well, as you mentioned in the last hour, I think we can say the call now into all of a sudden the jobs report important in December, the inflation report getting us to December 14th, and the Fed meeting is there seems to be a new call. Bonds, price up, yield down, buy bonds.
That's been basically one consensus out there, a little bit of pushback around the edges. And the corporate side of things, we have been talking about Disney all morning. And I keep going back to this question of, is this a Disney story or is this a broader, okay, now what story, now that we're past the pandemic and now that money costs something?
Should we go to the news here today? Alex Webb, I thought, was brilliant, quoting Peter Pan, second star on the right here. Disney, I mean, come on, this is a big deal today. Chapek out. Some people are not surprised. I'll be honest, I'm one of them. You know, I wouldn't like overtly say that on air. Nobody cares what my opinion is. But Mr. Iger returns.
But how much is this really the comeback of activist shareholders? And I ask this because
Alex said
you're
yes.
seeing that. You know, you're seeing Peltz come in with Trian taking a significant stake. How much are you going to see some others do the same thing as companies face off with the sort of painful, do we have to cut jobs, kind of like tech, or can we hold on to people? Where do you prioritize just keeping this staff at a time when you saw the real pains of losing people and not being able to rehire?
Another story today, China. I mean, there it is again, you know.
You know, are they going to be able to reopen?
Shut down.
Yeah, and this is the reason why you're seeing certain stocks kind of fall off in the hope of reopening China. I don't know. Right now, I'm seeing the biggest takeaway from the resets, the sort of look ahead, is that we're going to see more pain. And that's been basically Morgan Stanley. That's been Goldman Sachs out today with their outlook, basically saying that they see sort of meandering stock performance to the same place that we're at next year.
Bramall gloom.
It's not Bramall gloom. It's Goldman Sachs gloom. It's Morgan Stanley gloom. It's Wall Street gloom.
Should we do a data check today?
Let's do it.
I mean, you can start. I mean, there it is.
It's down. All right, I'm looking right now at NASDAQ lower by about 0.8%. You could see the S&P down a little bit less than that. You could see, not a lot of movement in terms of directionality. You could see a bit of dollar strength after a whole host of dollar weakness, 102.37 on the euro dollar. The 10-year is interesting to me, 3.825%. Remember we were talking about a 5% yield when we next would see that? Way off. And you've pointed this out, the oil price. What we've seen there is interesting as well. Just, are we going to slip further, given WTI below $80 a barrel, 79.59?
That wasn't the data check I was talking about. It's a raging debate, and this is out on the internet as well as at the Keene House. Do you cook turkey at 350 or at 425? It's a serious issue. I think you do both. Like you cook them hot first, bring it down, do the slow roast, and then bring it up at the end. But that would just be one theory. What do you think?
I think that you're not cooking this year, and I think you should do a Twitter poll. I think that's the issue.
Nixon was president when I last cooked.
Well, I think that turkey, unpopular opinion, nobody ever really likes turkey. It's sort of always too much is left over, and you end up, it's always dry. I'm just saying.
Before we get to David Riley, Lisa, this is important. Thank you to the Telegraph here in London. Of course, it's England and Iran. It's starting right now. We'll bring you that as well. Farrell's there. He's got a cell phone out so he can tell us what's going on. But very seriously, on the sidelines, Alex Scott of the BBC is wearing one of these armbands.
Interesting.
Interesting. And the media, they're sitting on the sidelines with their BBC Sport microphones, warbling gaily about the game and about the football. But they're wearing the armband the players can't wear. I don't know where that goes, but that's part of the social aspect of this World Cup.
Yeah, I wonder where that's going to go in terms of FIFA and just how much pushback there comes against FIFA. Right now, we're going to turn to some of the focus on the year ahead. One of the biggest consensus calls, go long bonds. David Riley, Chief Investment Strategist at Blue Bay Asset Management, here to weigh in. Is this your number one as well? 10-year, 30-year, the longer the better.
Yeah, I do think it's going to be a year when duration actually, pays off, and it will make sense to be long duration. I'm actually more inclined to go in terms of the Treasury curve towards the 5-year point, and that's because I do think that it's more likely than not that the US economy goes into recession. I think we'll probably therefore get some bull steepening in the curve. Normally you'd express that at the very short end, but we don't really know how far and how fast inflation will fall, and therefore we don't really know at what point does the Fed start considering rate cuts. I think the 5-year is probably quite a good sort of sweet spot, and with that I'd also be buying some high-grade credit at this level as well.
See, Tom, he likes the 5-year auction. That's what he was just saying right there. He's saying he likes the 5-year.
That's the only reason we book him is for Auction Love with
Exactly.
Lisa Bramowitz.
Well, thank you. David, I do wonder, though, at what point you're looking at a return to the old normal, right? At this idea that we're going back to an inflation that's sub 2% or even 2%, and other people pushing back. Where do you say to them, look, we're not going to have a high inflation regime for a very long time, and bonds will be able to reassert themselves in a way that we're used to?
Well, because I do think that we are at or very close to the peak in inflation. And, I think it's right to highlight just how much uncertainty we do have in terms of how far and how fast inflation falls. And that's obviously very critical for the Fed and other central banks, and therefore for the outlook for the bond market. But I don't see a sort of self-fulfilling or self-perpetuating wage price spiral. And if you think we're going into recession, as I think we are going into not only a European but also US and global recession, that's very negative in all sorts of ways, and sadly people are going to be losing their jobs on the back of that. But we know from experience that does bring inflation down. Inflation is going to be coming down. It's just about the pace and the magnitude of that through next year.
David, tell me about the value of cash here. If we're quote unquote going into a recession, is cash good or is cash trash?
I do think that as we go into recession, I think what is going to be of particular value is to have liquidity within portfolios. Now, some of that's going to come from having holdings of cash, but I also think it means a bias towards credit, core fixed income, which is now giving you a yield. I mean, one of the key differences, there's a lot of differences, but one of the key differences going into 2023 compared to when we went into 2022, when we went into this year, is that we're actually starting with much higher levels of yield, and that's giving you an income cushion which you otherwise didn't have at the start of 2022. So have some liquidity, have some cash. I think a bias towards the more liquid securities, but I don't think it's an environment. I think there are opportunities out there for you to deploy cash. I wouldn't be holding too much cash.
Right. David, we need you to get back to England, Iran. I know that's what you're really focused on here. We thank you for coming on. We've got people outside. There's a ticketing snafu at the stadium. iPlayer is down worldwide. But also in minute 3 with Maguire advancing, David, somebody talks about a stone bunker of a penalty. Pharaoh's not here, David. Save us. What does stone bunker mean?
You've called me out there, Tom. I'm not sure what stone bunker actually means, but it sounds like it's a nailed-on penalty that has been conceded. And by the way you described it, it sounds like it may have been conceded by England, which would rather be in keeping with the start that England often make to World Cup tournaments. A lot of a build-up and then some disappointment when the game gets underway. Let's hope I'm wrong, and let's hope it's different this time around.
David Riley with piercing analysis there in for John Farrell as well. David Riley, Blue Bay Asset Management. Can I make clear Farrell would exactly know what stone bunker means?
100%. And he would give us a very great historical picture of where that comes from. I just have to say, I'm getting quite a bit of hate mail about my dislike of turkey. It's not that I dislike it, it's just that it's never good. It's just like it's adequate. And people are suggesting that I don't brine it. And someone suggests that I do a bourbon brine, and then you would enjoy that too.
Brine. Take a sip of bourbon, brine the beast.
And other people are saying, yeah, that's one way to do it. I don't know. Leftovers. I can't do the leftovers for 2 weeks. I don't know. I'm sorry. These are the things that we think about. It's like, Thanksgiving, post-Thanksgiving, post-dinner turkey exhaustion.
We're going to solve this for Bramo right now, folks. And we say good morning in Thanksgiving week to Jerome Schneider.
Oh, yeah. He's going to come give us advice.
The website is Gobble Gobble. They are Greenberg smoked turkeys. Lisa, the kids will love it. You'll be ordering turkey every 30 days from Texas. Smoked turkey.
What are
Killer.
they? Shopping channel ahead of Thanksgiving.
Here
you go.
Exactly. England, Iran. Stay tuned. This is Bloomberg. Good morning.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Well, Prime Minister Rishi Sunak says the UK isn't prepared to align itself with EU laws as part of their post-Brexit relationship, following reports his government is open to Switzerland-style ties with the bloc.
Under my leadership, the United Kingdom will not pursue any relationship with Europe that relies on alignment with EU laws. Having the regulatory freedom to do that is an important opportunity of Brexit. And that's my agenda, and I'm confident that that agenda is not only right for the country, but can deliver enormous benefit for people up and down the UK in the years to come.
Sunak spoke today at the Confederation of British Industries annual conference in Birmingham. Food giant Cargill says named Brian Sykes as its new chief executive officer to replace David McLennan. Now, Cargill is America's largest private company. Sykes became chief operating officer a year after running Cargill's meat business. He will take on the top job on January 1st, and McLennan will become executive chair. 7 national football teams, including England, will not wear a rainbow armband, showing solidarity with LGBTQ rights, bowing to pressure from FIFA because players might receive a yellow card for the show of support. Qatar has been under intense scrutiny leading up to the World Cup over the treatment of migrant workers, as well as concerns about human rights and its criminalization of homosexuality. And it wasn't the start the hosts were hoping for on the pitch, beaten 2-0 by Ecuador in the opening match. Today, the U.S. takes on Wales. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
To name a couple of your babies. I don't know if I'm asking you to choose amongst your children, but you know, some of the most recognizable buildings by you, of course, the Millennium Bridge, London City Hall, the Reichstag, and the Great Court British Museum. What was your favorite project to do?
The Reichstag does stand out because, first of all, it's an energy manifesto. So it transformed something that was dependent on fossil fuels. It uses all the technology to produce something which is essentially carbon neutral. And as a public building, that's a statement. It's a symbol of a city, it's a symbol of a nation. It incorporates works of art. It's recycling an existing building, which, as I mentioned earlier, is the ultimate in sustainability. If you can give a new life to a building, it also creates public space at the roof level. It is the most visited parliament in the world, so it puts the public above the politicians who are answerable to them. And that, of course, was made possible by the politicians. So it's a demonstration of democracy in action.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Welcome to the world of decentralized finance.
I'm going to take a look right here at regulation.
We are seeing digital currencies under some pressure.
Bloomberg's covering all things crypto. The people.
I want to have some of my money outside of the sovereign.
The transactions.
It all comes down to the details here.
And the technology.
How does that affect disruptors like you?
What happens to everything that you're investing in when the last Bitcoin is mined?
Bloomberg Crypto, Tuesdays. at the Fed are on Bloomberg.
I think it will probably be appropriate soon to move to a slower pace of increases, but we have additional work to do.
Nobody covers the Fed like Bloomberg.
I don't think this is all over for the strong dollar trade. I think there's still a lot of pain to come in terms of the global economy. I think there's still a lot of hawkishness yet to come and feed through from the Fed.
Jane Foley, Rabobank, there, no doubt watching England and Iran right now with John Farrow. We thank her always for her perspective as well. And Rabobank, Lisa, has a really different approach. I say this all the time, but I think it's important. Our next guest is very, speculation. How do you make money here, et cetera, et cetera. And the bottom line is Jane Foley's working for a huge agricultural bank where it's about hedging business transactions to protect yourself. So it's the other side of the trade.
You mean when derivatives actually had a concrete purpose in the world, when companies, if you're a lumber yard, you've got to actually hedge against the lumber prices going down in order to back that up. And that's really where perhaps the biggest mismatch is, particularly in oil, right? Where does the physical world and the financialized world, where do they kind of cohere and where are they really diverging?
We're going to start strong this week with George Saravelis, Global Head of FX Research at Deutsche Bank. George, you're piecing it together with Dr. Folkerts Landau, with Alan Ruskin and the rest. What's your dollar theme of an outlook into 2023?
Hi, good morning, Tom. It's a much more choppy and sideways outlook. I think if you take a look back this year and look at when Eurodollar made the low around 95 in September, and think about what was going on back then. The UK had a fiscal crisis. European nat gas prices were at 300. They've now come down to 100. US CPI was still accelerating. China was still following strict zero COVID. So you had this confluence of risk negative events all adding up together. And when we look at the biggest driver of the dollar this year, it's all been about the safe haven risk premium. So the argument we've been making in recent weeks is that risk premium in a cumulative sense has peaked. It's just going to be very hard for everything to be as bad at the same time next year as it was this year. And as a result, the dollar has most likely peaked. But I think that's a very, very different conversation to arguing that the dollar will enter into this big downtrend. And we don't see that happening, at least over the next 6 months, over the first half of next year.
What does EM do? Where's the opportunity here in beleaguered EM currencies?
So I think in an environment where the dollar is choppier, essentially what we're saying is dollar correlations can go down. It's no longer one big trade. 2022 was essentially one big trade, sell everything and just own dollar cash. And if that's changing, you're in an environment with a bit more differentiation in terms of stories. European growth, Europe potentially emerging from a recession, I think as soon as Q1, China potentially accelerating. You're in an environment where some currencies can outperform in emerging markets that offer carry and real yield. And you want to be funding those longs, those high yielding currencies in things that still have very poor fundamentals. For example, the pound or the Swedish krona, which is faced with its own issues. So a much more tactical and idiosyncratic year, I think, compared to what has been a very, very one-directional move so far in 2022.
I love your bullish call on other currencies and bearish call on the dollar. It's very hard for everything to be as bad at the same time next year as it was this year. It's not exactly a screaming buy. I'm wondering, though, whether the euro is going to benefit the most from this lack of conviction around just hiding out in the dollar, especially, as you say, if they're emerging from recession in the first quarter.
So the euro can take out negative risk premium, so to speak. If you think back to where we were in September, nat gas prices, for example, are nearly 2/3 down. From a growth perspective, the market expected a very sharp recession from September, October onwards, which is materializing. Growth is shifting down to negative. But the reality is we've had a much bigger fiscal response than most people were expecting. It seems like this window for escalation around gas and the shortages is closing. So potentially that story is looking better. Now, to make the argument that you're going all the way back up to 115, potentially 120, and reversing the entire move since the war, I think that's a much more aggressive argument that requires you to be very optimistic on how the conflict goes. But can you take risk premium out as you have? can you stay above parity? I think the answer there is yes, because the environment is just not going to be as bad as it was over the course of this year.
A couple hours ago, Carl Weinberg joined us from High Frequency Economics and was talking about this stealth quantitative tightening that was going to take effect in the Euro region come Wednesday, that about $300 billion of loans to banks would be redeemed and they would get the bonds back that backed them, and that this was going to cause long end yields to rise substantially, that people really hadn't understood this. What's your understanding of the quantitative tightening consequences in the Euro region?
So this was this is in response to the TLTRO repayments were announced on Friday. They were actually significantly lower than consensus. They were around half. The market was expecting 600 billion, and we only had 300 billion of repayment. So from an ECB perspective, you're actually not getting as much quantitative tightening potentially as they would have hoped. We need to wait and see what the December repayment numbers are going to be as well. But either way, the point I would make on Europe is if you look at things like five-year GDP-weighted real yields, they're actually not that high. If you look at the DAX, it's less than 10% down from the start of the year. So financial conditions in Europe have not tightened nearly as much as in the US. That's another reason why potentially the ECB can stay hawkish. Now, whether that's via more QT or via more rate hikes, it remains to be seen. But that's also a story that I think could be more supportive for the euro compared to the Fed, where we're slowly, the conversation is evolving into the question of when do we get the pause? I think cutting is a very different question, but at least can we enter a pause in this cycle? That's a much more valid debate to be having over 2023.
George Servalos, thank you so much. Really look forward to the Deutsche Bank view forward into 2023. He is, of course, in London with Deutsche Bank. Lisa, I'm watching the game here. John Farrow waved to me from the stands, which is great. England 0, Iran 0. And what's fascinating here, you know, thank you, Steve Jobs and Tim Cook for doing
Everyone's thrilled that you're watching the game on air while you're trying to
Can we do some
focused
business
on
here?
this.
What's fascinating to me is they look in the corners Iran attacks, and there's a Budweiser advertising. And yet Friday we were talking about Budweiser couldn't sell beer at the game. And right in the same corner is Crypto.com. I don't know who Crypto.com is. I went to their website, and this is the heart of the Katie Greifeld matter of Bitcoin. Receiving rewards up to 14.5% on your crypto assets. All of this Bitcoin debate we're having is about, with us, you can make 8%. With us, you can make 10%. In this case, there it is on the website. With us, you can make 14.5%. I think you and I call this a free lunch.
Right. How can you get rich quick? I'm just still distracted by the fact that you've been watching the game this whole time.
No, I wasn't. You know, I'm sliding in there.
Is it a good game?
It's different, very different from Ecuador, Qatar.
More energy on both sides?
Yeah, way more skill. I mean, what do I know?
Well, I don't know.
John, come on.
Yeah, exactly. He'll phone
it's like
it.
E.T., come on.
Do a
John,
phoner.
John, come on.
They're heading into the end zone with the Dow.
John, come on. John.
That's not working.
Lots happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight
A lot of these areas still have very, very good valuations.
from businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot. We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
You do not get stronger that moment that you're lifting the barbell. You get stronger as your body is making repairs, making recovery. Recovery is a when and how you get fitter, faster, stronger.
Recovery technology includes everything from massage guns and foam rollers to compression boots, hyperbaric chambers, cryo chambers, infrared saunas, and even infrared pajamas. And athletes are partnering to become investors to take those products mainstream.
When you look at tech in sports right now, it's completely innovating the way training's going, completely changing the way recovery's going. I think sky's the limit as far as where it can go.
But while some of these products can feel amazing, it can be difficult to differentiate between what really helps the body and what just tricks the mind.
Every time you're chasing the latest, greatest, newest tool, you're probably chasing a mirage.
No one covers the world like Bloomberg.
My team thinks 2023, we avoid a recession. I'm a little more skeptical about that.
China and the U.S. both do not want to see nuclear force on the European continent.
The regulators here in the Bahamas are ongoing with their investigation into FTX.
With unmatched reach and resources from more than 120 countries, the moment news breaks 24 hours a day. Bloomberg, your global business authority. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
Good morning, everyone. Bloomberg surveillance. Futures, well, negative 20 now, negative 13, so I guess that's an advance in a very churning market waiting for information as well. On the data front, I'm going to give you American oil at $79.50 per barrel, under $80. That gets my attention. And again, the yen, Sarah Vellis didn't play it up much at Deutsche Bank, but we had a 142 yen there, which is a weaker yen, first time in, I'm going to say, 2 weeks.
How much does that have to do with China and the idea that any kind of reassertion of COVID lockdowns could end up really reducing some dynamism there?
Half back to the fullback.
Yeah, this is what you're going to be dealing with for literally another 90 minutes.
Half to the fullback, half back.
And I'm sure everyone's really enjoying this. We're still on air.
England
you know that, right?
keeps kicking the ball back to their goalie. I didn't think that was the way.
That's a classic move. Even I know that. Really, honestly, people are now throwing things at the screen. I am so sorry. Now I'm going to take Jonathan Farrow's role. I'm really sorry.
Veronica Clark
really
looking at us as
appreciate
well.
Football.
Now, see Veronica, there it is.
Why are we doing
We're watching the game. They haven't had a shot yet. England's trying, though.
Tom?
We'll have to see. Okay, Veronica Clark is working with Andrew Hollenhorst at Citigroup as they adjust to their call of the year. I would suggest maybe with Deutsche Bank out front first with a ramification of global slowdown and particularly the vector of interest rates higher. That's what everybody wants to know. You sit with Hollenhorst over a Starbucks coffee in the morning and you say, where's the terminal rate? Where's the new Citigroup terminal rate?
Yeah, we have the terminal rate now at 525 to 550 and getting there by the May meeting of 2023.
Why is Bullard wrong when he talks about 7% X number of days ago?
I mean, he might not be wrong. He's been kind of a leading sign for the Fed this year, and I think it's fair to think that the rate needs to get to anywhere from 5 to 7.
But the lag effects, not to channel Leo Brainard here, but there is a question of how much companies are already feeling a lot of tightening, and they're ratcheting back their plans for next year and may have to really cut some staff. So from your vantage point, how do you dismiss that as a relevant factor for the Fed?
I think that is very relevant, though. I mean, we're anecdotally hearing that people are cutting back now, but you really haven't seen it in the data yet. And that's really what's going to be most important for us, most important for the Fed, is just what are you seeing in the inflation data, and then also importantly the labor market data. And we still have really low initial jobless claims. It still seems job openings are high, and there's not enough loosening yet.
But this is the important point when you talk about tech layoffs, and we've talked extensively. We've got Amazon cutting 10,000 jobs. You have Twitter, of course, its own story. You have Meta cutting thousands of jobs. How much do you look at this and say it's a tech story, and it's a tech story that could deepen, but it's tech isolated?
Yeah, I mean, I think it's fair to see, first the weakness in sectors like tech or real estate. Of course, the housing market would be most affected first by rate hikes. But eventually, you probably do see it broadening out to the rest of the economy. We think we see that really, as we're getting into 2023.
When you talk to your markets people, how do they link the Hollenhorst-Clark analysis into what the stock market will do? That is part of economics, even at New York University.
Yeah, no, it absolutely does matter. And the story of the last year has been, of course, higher rates. That's tighter financial conditions, lower equities. The last couple weeks, after CPI, maybe we've reversed some of that. But I still think, the momentum is maybe, risk assets still lower.
What does investment do?
Business investment next year.
11% of the economy, 15%?
Yeah, roughly. I mean, it should be slowing, and we've already seen that, of course, in any housing-related investment. That was very weak in Q3 GDP, should be weak again in Q4. But yeah, eventually, especially given that goods demand has come off, you should see businesses pulling back, less manufacturing activity, that type of thing.
And this is a segment where we go into housing, and Tom talks about how he expects something more significant, and a lot of people are saying, yes, that seems to be the most logical conclusion from a 7% mortgage rate, and other people saying no because of just the behavioral aspect of this, which we were talking about earlier. People are going to stay put. There's going to be less mobility. If there are fewer homes for sale, you're not going to necessarily see the realized price declines. How do you game that out in this controversial moment of really historic weakness for the housing market?
Yeah, I think there is still more weakness to come, but yeah, it will matter, what's happening on the supply side, where you do get this pullback in construction also, and so there's less housing stock, and maybe then prices don't fall as much. But what we have seen so far is that home sales are falling, construction's falling, and prices are also falling.
But could you see a real rout, not necessarily akin to the 2007-2008 leverage-fueled destruction, but something more significant after the bid up that we saw during the pandemic, and then the Dallas report, the Dallas Fed report, that really highlights how it could spiral, especially as people get less optimistic about how much their homes are worth?
Yeah, I wouldn't expect that we're in a 2008 type scenario. That was a pretty housing specific bubble that popped. But of course, housing is weak, and it tends to be somewhat of a leading indicator for the rest of activity. But I think more what's happening is housing is just the first to feel the impact of Fed rate hikes, and eventually you see it in consumption that's slowing down, other business investment that's slowing down, people losing their jobs. But it's all coming back to that what the Fed has done.
So what's the path to December 14th? It's a sleepy Monday. Futures improved -20 out to -14. We're going to get Wednesday. You're cooking Thursday, right? Do you start cooking Wednesday?
Yes, probably tomorrow even.
You're going to start? That's sick.
Yeah.
Really?
I have a very small oven, so I need to plan these things. Yeah.
Okay. Well, we'll talk to Hollenhorst about that. I mean, I can see Ms. Clark with the Viking, the big, 6-burner Viking.
I'm sorry, I'm still weeding through all the hate mail that I got about turkey.
Well, good.
So it's really, carry on.
But seriously here, we got to stagger to December 14th. Is this a snooze fest, or is there actually going to be some real change in the tone as we get to December 14th?
Yeah, I think it could be an interesting couple weeks. This week is, relatively slow on important data. Of course, we'll get Fed minutes on Wednesday. That November Fed meeting feels like a long time ago, but it could be an opportunity to somewhat hawkishly push back on markets. Next week, of course, we'll get a lot of labor market data. That will be very important. The payrolls number.
I think it's more important just in the last week, right?
Yeah. I mean, we're really looking for, I think for the Fed right now, if we do get some slowing in inflation, which it seems like we might, but you're not seeing it in the slowing in service inflation. That's related to a tight labor market, and then you do need to see that loosening in the labor market data.
Okay, but I got something else I want to chat on, but I think this is really, really important. What part of the jobs report should our listeners and viewers study?
Yeah, I mean, all of it matters, which is, I know.
That's what Hollenhorst would say. Give me a value add here.
Yeah, all of it matters. I think maybe most interesting, what I would be watching first is what happens with the unemployment rate. It did tick up last month for October. If it falls back again, that's still a really tight labor market.
What's the one issue that the team over at Citi argues about the most, where there's the most disagreement?
Question. Thank you.
That's a good question. I don't know. I mean, I think we're relatively in consensus. I think maybe, it could be hard as we're getting into next year to know, exactly what the Fed is doing when you get more of this debate between the hawks and the doves. And I think we do want to remember that, we've been very hawkish this year. The Fed has been too. But this could be somewhat of an inherently dovish Fed. This is a Fed that cut rates 3 times in 2019. We might get more debate, among ourselves too, just exactly, how it plays out next year.
There's going to be a discussion around the Thanksgiving table. This comes up every single year. You're Sarah with the cherubs. The cherubs never talk to you anymore. And you're going to talk about education. You did one of the toughest grinds, mathematics and economics at Chapel Hill, and then economics at NYU. How do we keep women engaged in mathematics to get them through high school and into college? I mean, I know there's a huge improvement there, but what was it that kept you engaged in mathematics?
I had really great teachers in high school, and I'm not an education expert. I don't know how you improve that, but I think it does matter just having really great teachers, who I struggled at points, but then they brought me back up.
Did you get through imaginary numbers like square root of -1? You
yes,
survived?
yeah. I did not do complex analysis, but of course I had to do a real analysis class.
Okay. Veronica Clark on the complex analysis to December 14th. As well, you nailed complex analysis at Chicago, right?
Well, my father's a mathematician, so I lived it. We had lots of discussions.
I got to cubic functions. I nailed it all. I was like first in the class, blah, and then cubic functions showed up. I was like, oh, really? Remember that?
Yeah,
you got it completely down analytical geometry, then, oh.
Amazingly, I don't use complex analysis now in forecasting.
Well, let Horowitz do that. What does he know? Veronica Clark, thank you so much with Citigroup today. Lisa, what do you see here on this Monday morning?
It's a quiet Monday. Look, we're not going to try to overplay the action. What I do think is interesting, actually, I keep going back to what Katie Kaminsky said, this idea that she's seeing mixed signals on the short term and the long term. And to me, that's fascinating. The other thing that's fascinating to me is to see how closely you're scrutinizing your phone right now to watch the game rather than, anything else. Because honestly, that's probably what most people are doing.
No, we're going to do both. We're going to do both. You listen to Bloomberg Radio while you're watching the team, while you're watching the screen. I mean, England came in with a corner kick and they hit the crossbar. That sounds like the England we know and love. And then they scored a goal. I didn't see the goal because I was talking to Ms. Clark here about the Fed meeting. December 14th. I was distracted by our guest. What is that about?
I know, but this is what people are watching. They're watching the games.
Imagine next week.
Yeah, exactly. Although we're actually getting labor market data rather than this week. We're getting Fed minutes on Wednesday afternoon. I know you're going to be glued to it. It's going to be
seriously,
amazing.
I don't know where we are in time. Let's go back to Ms. Clark on this. I mean, Wednesday, you're trying to get out to cook the beast, and there's like 4,000 data dump economic statistics.
I know. We
Which
have
one
so
matters?
much data. We have so much data. I mean, the Fed minutes that day at 2 are probably the most important thing.
Oh, you're killing me.
Look at that.
Of the
Do
data.
you read the Fed minutes?
Of course she does.
I skim them.
Thank you.
But
There's the
hold on a
honest
second.
answer.
But in all honesty, this is why she starts cooking now, because she's got to read the Fed meeting minutes at 2 p.m. and scour the data. You look totally convinced, Tom.
She skims them.
Is that a ticket for you to
Heavily
skim
them.
Heavily skim.
Hollers went to UCLA where you have to lean over the desk and look at the beige book.
What is heavily skimming?
Several, some, a few.
Some few, many.
Look,
that's
I
language.
okay, we'll see. We'll see what happens.
Let's save ourselves with a data check. We do that with oil under $80 a barrel in America, $79.50 as well. Dollar stronger is an important tone today, led by weak yen, 141.77 on yen, nowhere near the 148 level, but a bit of a reversal on the dollar weakness we've seen the last number of days. Must watch, must listen. Peter Oppenheimer in the 9 o'clock hour with Lisa Abramowitz. Oppenheimer of Goldman Sachs. Please stay with us. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. In Indonesia, at least 46 people are dead and about 700 others injured after a 5.6 magnitude earthquake shook the western Java region today. Several homes, stores, and public buildings are damaged, and landslides are reported following the roughly 7-second earthquake. Tremors were felt in nearby cities, including the capital of Jakarta. Ukraine plans to raise transit fees for Russian oil through the Druzhba pipeline to Eastern Europe next year due to Moscow's attacks on the nation's power supplies. The operator of Ukraine's oil pipeline network informed its Russian counterpart that, quote, continued destruction of the Ukrainian energy infrastructure has led to a significant shortage of electricity, an increase in costs, a shortage of fuel, spare parts. That's according to a letter from the company seen by Bloomberg. Twitter's head of France announced his departure. Damien Viel led the region for about 7 years. A number of workers at the Paris office, which had fewer than 50 employees before billionaire Elon Musk took over last month, are focused on advertiser relationships. Musk is considering additional layoffs and has already slashed Twitter's workforce in half. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
Progress.
So is there more pressure when you're trying to win a basketball championship than when you're trying to please investors? Where's the greater pressure?
Oh, I think it's definitely trying to win a championship. It's hard because a lot of, like when you invest, and you know this, when you're investing, you can control a lot more things. When, you know, on a basketball court, you can't control whether somebody's going to make a shot. You've got to get lucky.
And what's the greater pleasure, making 5 times your money on a distressed debt investment or winning the NBA championship?
They're both fabulous. I wish I could do one each year. That would be great. But I think there's a great feeling in being right on an investment that you've done a tremendous amount of work and you've made money for your clients, which I think is great. I think winning a championship it's a very surreal feeling because there's a whole city or state that is actually behind you. You know, we had 70,000 people at the finals, and we had them all outside. You had 17,000 in the stands, and then literally like 60,000 people outside. And when we won, like just the joy that you had brought to the city was phenomenal.
When I started, I had no idea it was going to turn into this, which is a tracksuit empire. I don't have any investors. All this is all money in. This is me going out and hustling, bringing that money back, and just building it, building it, building it.
You gotta think about a person that was homeless at one point, didn't really have any money coming in. The fact that this person was relentless and just determined to succeed and not let rock bottom define him as an individual.
I can take things and put them together and take them apart and make them better and put them back together. I respect the craft, so I don't want to minimize and disrespect the value of each step of the craft and do by machine what should be done by hand.
Stages of a sustainability revolution that has the magnitude of the industrial revolution coupled with the speed of the digital revolution.
Nobody covers climate change like Bloomberg, your global business authority.
This economy is still the most resilient economy in the world. Having said that, our economists are predicting a shallow recession in 2023 because this U.S. economy is still very quite interconnected with the rest of the world. We expect a rebound in 2024.
He's from France and New York, Jean-Yves Filion, providing guidance to BNP Paribas USA as their chief executive officer. Always a good conversation, and particularly we tilted it towards France. Could they repeat in the World Cup? They had a very tough injury this weekend, and we'll have to see on that. For those of you watching, thank you for watching. England-Iran. England pulls away 3-0. Right now, we've been watching that as we can here. Lisa Abramowitz with trenchant analysis is preparing for the 9 o'clock hour. I'll prepare for England and Wales this afternoon. That'll be fun. Right now, and this is not fun because it's William Cohen taking on a very difficult topic, which is power failure. And this is simply the collapse of an institution of my childhood, power failure. William Cohen, thank you so much for 700 plus pages on this. My childhood was moving west on the New York State Thruway by the industrial might of Jack Welch's America, the GE factory in Schenectady and all, Welch coming from Pittsfield, Massachusetts as well. When did they begin to fail? Was it the financialization of a light bulb maker?
Well, Tom, first of all, thank you for having me. It's great to see you again. Look, I think, GE Credit, which became GE Capital, started in the Depression to help finance people's acquisition of GE products, of appliances, etc. Jack, however, when he took it over, recognized that there was a huge arbitrage opportunity between GE's AAA credit rating and its low cost of capital and what it could lend that money out at large spreads, including with warrants, Tom, which was something that Mike Milken perfected. And I started my career on Wall Street at GE Capital financing leveraged buyouts, so I actually did it myself for 2 years. And so Jack built that business up so that it was almost 50% of GE's profits. And he understood that business. I think he understood the risks of that business. Right. And he also had people like Gary Wendt in charge there who understood the risks in that business.
The people side of your book is absolutely phenomenal. Page 296, a guy named Bob Nardelli joins up, Old Forge, Pennsylvania, between Wilkes-Barre and Scranton. You turn the page and you've got Walter McNerney going to New Trier in Winnetka. My mother went there as well. It's a people book. Which is the person we should focus on when we look at the collapse of Generous Electric?
Well, it takes a village sometimes. I mean, Jeff Immelt was obviously the CEO for 17 years, from 2001 till 2017. So, I mean, he gets the lion's share of the blame, I'm afraid. Did Jack sort of set him up for failure? That's a question that people are wondering about and asking.
How does the applied mathematician from Dartmouth screw up so bad? Was it a single mistake that Mr. Immelt made, or was he just a victim of the times?
I think he made a series of what he thought were the right decisions, but that turned out in retrospect to be the wrong decisions, whether it was, buying Alstom, selling NBC Universal too cheaply, kind of freaking out during the 2008 financial crisis, getting out of GE Capital, bringing in Trion, Nelson Peltz, thinking that Nelson Peltz would ratify his vision for GE and then promising earnings per share that he couldn't achieve. That was the end. I mean, it's not dissimilar to what just happened with Bob Chapek and Bob Iger. Or Disney. I mean,
let's rip up the script here, Bill Cohen. You can do this. I'm sure you're going to write on Iger and Disney here in 5 years. House of Cards, Money and Power, now Power Failure. Could this process exist today, or are the markets so open and visible, particularly to activism, that we couldn't redo GE Welch to Immelt?
Well, you know, GE was really a very large company when Jeff thought it would be a good idea to invite Nelson Peltz to come into the equity of GE in 2015 to,
right.
You know, that didn't have to happen. So, I mean, Dan Loeb obviously went into Disney earlier this year, spent $1 billion, saw the stock go down 40% and moved to ACT. Nelson Peltz did the same thing when he saw that Jeff Immelt no longer had control of the company, and he did it again, unfortunately, when you know, it was time for John Flannery to leave after 15 months.
Bill Cohen, not to sell one of your ex-books, I know that's tacky in a book interview, but I've got to go to Money and Power and your definitive guide to Wall Street's Goldman Sachs. Your thoughts on the present state of Goldman Sachs, the market's challenges, and perhaps the cultural challenge that David Solomon faces right now. What do you look forward to from Mr. Solomon and Goldman Sachs?
Constantly evolving, Tom. You know this as well as anyone. Goldman is extremely nimble. David is a very clever, smart guy. You know, has he made missteps? You know, of course. I mean, he tried to get the bank into more retail banking with Marcus and making loans and cash management. Maybe that's a tougher business than he thought. You know, his trading business had a great quarter last quarter. Investment banking has had a rough year across the street. Trading helped Goldman. Goldman is a perfectly designed creature to take advantage of opportunities in the financial markets. They have been doing that for 160 plus years. They will continue to do it. They are one of the oldest surviving financial institutions we have in this country. They know how to survive.
I'm going to call this a Daniel Yergin equivalent. William Cohen with us, folks. Power and Failure. Bill Cohen, thank you. Cohen, thank you so much. The thickness will fear you. 700 plus pages of Cohen. I won't mince words. It reads like Daniel Yergin. It just reads wonderfully supple, wonderfully fluid here from all the different people, including Bob Nardelli, and on to the collapse of this American icon. Power, Failure, the rise and fall of an American icon. I really can't say enough about it here today. Futures negative 12. The tape's a little improved here, and the tape is quiet. You can see on the Bloomberg Launchpad the red and the green, the way it pulsates, what kind of day it is, and it's a day waiting for a lot of economic data into Tuesday, and a ton of data, as we heard from Veronica Clark, on Wednesday as well, and then on to Friday, and on seriously into a tumultuous December. It's going to be interesting to see where we sit on December 15th as well. Let me do a complete data check. We sort of avoided that today. Farrell would have never done that. Farrell, even watching England Iran, Farrell would have done a complete data check. Futures improved negative 13, Dow futures negative 11, SPX 24 on the VIX now 23.83, a more constructive tape in the last hour. Bonds, boring. We won't go there. I'm going to go to the dollar, stronger today by a good 0.7% on DXY. Euro under 103, 102.55. This is Bloomberg Surveillance.
This
watching and says, I want to be Ari Emanuel when I grow up, what should somebody do to get into the talent agency business or the business you're in?
Well, it's hopefully what I've taught my kids. You got to be intellectually curious. You got to be, you got to show up. And you know this like I know this. I got on a lot of planes. You just, even though that voice in your head is saying, oh God, I'm so tired, I don't want to do this. You got to show up. You got to be charmingly relentless. You have to build emotional endurance, because there's no straight line to success. It's kind of all over the place, and you have to just be able to work through those things. And then I think one of the things that I do every week is I try to create serendipity.
Multi-trillion-dollar industry. There's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ. Monday on Bloomberg. The top names in climate change are on Bloomberg.
Building out local wind, local solar, hydrogen, these are solutions to not just climate issues, but geopolitical issues.
We are in a position by 2030 to have 80% of all electricity generated by wind.
Renewables are the safest, the cleanest, and the cheapest form of energy today, especially for countries such as Greece.
Nobody covers climate change like Bloomberg, your global business authority.
From New York City for our viewers worldwide, I'm Lisa Abramowitz in for Jonathan Farrow. Right now, we are looking at a softer tone to markets, but it is quiet ahead of a Thanksgiving shortened week, down just 0.3% on the S&P. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
We begin with the big issue, gearing up for a turbulent year ahead.
There is going to be pain.
Slowdown with respect to growth.
The U.S. is going to be flirting with a recession.
We have probably a pretty powerful recession coming.
When you have this magnitude of rate hikes in such a short period, and you're also withdrawing liquidity through quantitative tightening, it's going to bite.
Wages have not kept up with prices. Real income's coming down.
Thankfully, it's also now starting to bite inflation.
That doesn't mean that we're going to now swiftly go back to 2%.
A lot depends on what the Fed does.
The market is asking the Fed, are we there yet? Are we there yet?
Trying to fine-tune where is the peak of interest rates.
The Fed keeps saying, no, sit down in the back seat and be quiet.
There are huge opportunities underneath the surface.
We're still going to be facing an awful lot of volatility in 2023.
Meanwhile, investors hoping for a better 2023 are poised for a disappointment. That's the view from Goldman Sachs, expecting the bear market to last into next year, writing, quote, the near-term path for equity markets is likely to be volatile and down. The conditions that are typically consistent with an equity trough have not yet been reached. I am so pleased to say that joining us right now is Peter Oppenheimer of Goldman Sachs, who penned those bearish prognostications. And I am wondering, from your perspective, just how bearish are you? Why do you see this as continuing, and how much further?
Thanks, Lisa. Well, I think the key point here is not that we're so bearish in terms of, I think that you're going to see some more volatility and another move down. But I think that the conditions, in our view, that need to be in place to establish.
Peter, I think that we're having some trouble with your audio, so let's try to reconnect, and hopefully we can get back to you. Maybe as we try to reestablish the line, there is this issue as we take a look at the bear market not being over, Morgan Stanley agreeing and believing that there is going to be some sort of downturn. Morgan Stanley seeing it going potentially down to S&P down to 3,000 before coming back to the hope phase. Joining us now to discuss how to sort of position ahead of a tumultuous year, JP Morgan's Jack Manley and Mike Kontopoulos of RB Advisors. Mike, I want to start with you, and I'm really curious from your perspective with all the bearishness, we haven't seen it percolate into credit. Is this a supportive factor into next year, or is this something that could potentially be problematic because it will also get hit as companies start to have to actually refinance?
Lisa, I think it's problematic. I mean, you know, the credit market is kind of living in a fantasy land right now. They're really pricing in just an ideal scenario where the economy slows just enough to bring down inflation, not enough to you know, dent earnings growth or increase defaults much. And I think that's just sort of a bad hypothesis. I mean, you look at 2023 and it's clear we're going to go into an earnings recession. You know, high yield credit, for example, does not do well when you go into an earnings recession. It doesn't matter how strong, you know, balance sheets are today, they're going to weaken as earnings growth slows. And then, of course, listen, you've got much higher rates and incredibly tight lending standards, and that's going to prove problematic for portions of the loan market, anybody who has to refinance in the next couple of years. And I think sentiment's going to get dinged up pretty bad, and that's not good for broad risk assets.
And that really speaks to what Peter Oppenheimer was talking about, and hopefully we can reconnect with him given the technology fissures. But I wonder, Jack, from your standpoint over at JP Morgan, whether you do agree that there is going to be a trough further out in the distance before we get to that capitulation, after which perhaps you could get a more sustainable rally, but we're not there yet.
Yeah, I mean, I would certainly agree that the credit fundamentals don't really line up with what reality is showing us. I guess on the equity side of things, the silver lining here, the good news here, if you want to be sort of optimistic about it, glass half full, is that, well, a lot of what's happened this year, in fact, basically everything that's happened this year has been driven by multiple compression. So the good news going into 2023 from an equity market perspective is that stocks aren't expensive anymore, at least not in the way that they were at the start of the year. The problem, of course, is that earnings shoe has not really dropped yet, and the big question right now is just how bad are earnings going to be as we move through 2023. I don't think anybody is expecting good news from an earnings perspective. It's really just a question of how bad it actually is. But from that valuation perspective, from the multiple perspective, Lisa, that is at least one thing that's keeping me modestly optimistic about short-term equity performance potential.
And this sort of tension right now between valuations being low but potential outlooks deteriorating has been highlighted by a lot of Wall Street research, including Morgan Stanley's Mike Wilson, who just wrote, quote, "We still expect higher highs for this tactical rally," so that's the positive, "before the deteriorating fundamentals," that's the negative, "take us to lower bear market lows next year." How much, Jack, have we already seen, though, some of that disappointment bled into this last quarter's results, because there were a lot of disappointments and they were severely punished by the market action?
This whole year has been a disappointment. I mean, it's been an extraordinarily challenging year to be a strategist and try to figure out where things are going over the short or medium term, because at every turn, you are being challenged by something new. I mean, I could see another 5–10% lower on this equity market. I'm not particularly optimistic about this current rally. I don't really think it has legs. I don't think it has a whole lot to stand on. But I do like that valuation story, Lisa. I don't want to, you know, beat a dead horse here, but markets are off so much from where they were in January that I think if you extend your time horizon by more than 12 months and look out over 18, 24 months and beyond, the story starts to get a lot more interesting, because 2023 may not be a great year for earnings, but 2024 probably will be a pretty decent one. And if we can get over this trouble, if the recession that is coming ends up being shorter or at least shallow in nature, I think we can look beyond the short-term chop and focus in on that longer-term story.
Meanwhile, from the nuts and bolts of cash flow, Michael Kontopoulos, this has been one of the key issues for me, and I read this in your note and I thought it was fascinating, where private markets are with respect to default rates, where private markets are with respect to companies really rethinking their ambition, because it's just expensive to borrow money. It is expensive to expand, and that really gives a feeling for how long the downturn could be and how much layoffs could accelerate. What are you seeing in the private markets that arguably are more leveraged than public markets in pockets, and what does that tell you about the future ahead?
Yeah, Lisa, if you think about what's happened over the last 10 years, I mean, the traditional investment banks have been disintermediated from financing the riskiest companies. I mean, that's what, the post-global financial crisis regulation was meant to do, is to shore up bank balance sheets, which, by the way, hasn't really seemed to work very much if you go back and you look at all the hung bridge loans and deals that basically can't get off dealer balance sheets these days. But besides the point, listen, private markets stepped in to basically fill the void in financing the worst of the worst companies. And that only got worse as you had a bubble sort of percolate in the broader economy and broader markets because of infinite liquidity. And that's all about to unwind. I kind of think it's interesting that, most private managers out there tout how you'll realize lower defaults because of their ability to basically shepherd a troubled company through trying times. And yet, private defaults today, by some measures, are close to 4%, while public debt, which is probably the safest market that you've had in the high yield space in decades, public default rates are closer to 1 or 1.5%. So it's nearly 3 times the default rate in the private space right now. And that goes to sort of what I was mentioning earlier, right? 2023 is going to be a really challenging year, I think, for broad equity markets and credit markets in general. And the playbook's pretty obvious. The playbook is you have to get defensive. You don't own illiquid markets like private credit in these types of environments. There'll be a time for that in the future, but next year's not it.
All right, well, meanwhile, we'll get back to this and really dig a little bit further. In the meantime, on the macro phase, China COVID fears have been reemerging, worsening outbreaks over the weekend, stoking concerns that authorities may return to tighter restrictions. Bloomberg Kaylee Lyons joining us now with more. Kaylee.
Well, Lisa, it's a worsening outbreak, not just in terms of total cases, but the fact that we actually had fatalities reported in China for the first time in about 6 months. So this is throwing a huge bucket of cold water on the whole idea that this economy was going to be reopening and these curves were going to be loosened. Now the fear is that they might be tightened once more, and that is weighing heavily on Chinese stocks. We saw that in the Asian session overnight, and that is continuing here in the U.S. session with those ADRs under pressure. Alibaba, Baidu, Bilibili, JD.com, all down to the tune of 2 to 5%. Of course, JD.com, one of the big underperformers, down nearly 5 percentage points. But of course, it had rallied 52% from its recent low in late October. So there was a big buildup coming into today, and that has really been true for the broader group of Chinese companies listed here in the U.S. because of what has been a series of good news events, earnings better than expected, seeming easing of relations between the U.S. and China. You had support for the property sector as well, and what until today seemed like it would be an easing up of COVID zero policy. So all that together had the NASDAQ Golden Dragon China Index up about 33% from its low in late October, but it still remains down 33% on the year. So it just goes to show you how far we had fallen. And then outside of equities, I want to talk about commodities as well, specifically iron ore, which is very sensitive to the China growth story in terms of demand. Because of all that reopening optimism, we have seen it have a very, very hot November, up about 23.5% this month, giving back some of those gains today, which was actually only one of 3 days in the month of November thus far that we have seen these futures moving lower. Obviously today, that based off of the new COVID news, and that news as well, part of why Goldman Sachs cut its oil forecast for the fourth quarter. They now see Brent at $100 a barrel rather than $110 a barrel, given what they see as the possibility of further lockdowns. What I will say though, Lisa, is that may be bad news for commodities prices if you're long. Could be good news on the inflation story if China's reopening is delayed further.
Kaylee Lyons, thank you so much. Well, you mentioned Goldman Sachs, and Goldman Sachs is with us. Peter Oppenheimer, we apologize to you and thank you for bearing with us through the technical difficulties. Peter, from your vantage point, this has been one of the underpinnings of the recent optimism, is the potential reopening of China as well as Europe avoiding the worst case scenario. How much is that going to play to the next leg lower in the bear market if that optimism isn't totally founded, at least to the degree that the market is pricing in?
Thank you, Lisa, and apologies for the connection before. You're quite right. There have been some good pieces of news that markets have absorbed over the last few weeks. Signs of an opening up in China, as you mentioned, a very mild winter so far in Europe, gas prices have fallen, and of course that evidence that US inflation is reaching a peak. But we have to acknowledge that markets are really pricing that. Let's not forget that the S&P, for example, is trading at a P multiple of over 17 times, pretty much where it was at the beginning of the year, despite the fact that real interest rates have broadly doubled since then. And we're still looking at around zero earnings growth in the US next year, less in places like Europe. So I think the markets are going to be exposed to marginally any more difficult news that comes through, particularly on growth over the coming months. And we don't think we've yet hit the sort of conditions that we would typically see at a genuine trough in a bear market that helps to form the base for a sustained rebound.
What kind of downturn are you looking for? I know that Michael Wilson over at Morgan Stanley has talked about the potential for even a 24% decline from here to 3,000 on the S&P. Are you in line with that kind of projection?
Not quite to that level, no. We're not so negative about the downsides from here. We just think there'll be more volatility and a trend towards a lower market level before we get that trough. The reason we're not quite so negative is because there are some positives. We do think that the US economy will avoid a hard landing. We think that there is going to be recession across Europe, but even that is likely to be relatively mild. And we should acknowledge that private sector balance sheets are pretty good, in particular banks and broadly corporates as well. But notwithstanding that, valuations haven't really yet fallen to the sorts of levels you would tend to get as investors worry about an economic and a profit downturn. And also, we're likely to see further weakness in growth momentum in the next quarter or so before we really get to the nadir, the worst point in this downturn. It's not really until we hit that markets tend to recover. And I would say just finally on this point, there is a lot of optimism now that the pace of rate increases is going to slow as central banks get a little bit more confident that inflation is closer to a peak. But that said, you don't typically get markets reaching a trough until interest rates actually start to come down. And we're still a long way away from that.
Well, and we were just speaking with Jack Manley of JP Morgan, Mike Katopoulos of RB Advisors about the fundamentals and how much free money kind of fostered what we saw and then the lack of it, the downturn. And from that perspective, how much can technology shares really continue to regain leadership position? And we've talked a lot about that this year, but when we do get those rate cuts, will it be technology that outperforms and drives the equity indexes higher? Or will it be someone else, or will it be a more even weighted kind of a rush?
I think it's going to be a lot more even weighted, a lot more eclectic. What we're really seeing this year is the reversal of the trend that we saw in the post-pandemic era that was supported then by zero rates and a lot of money printing. And that really pushed up the value of the longest duration growth stocks towards record highs. And it's not that there's not going to be great opportunities in technology. I think there will be. But valuations still need to come down. They have been, but they still remain relatively expensive compared to the more traditional and value-orientated parts of the market, which have been outperforming this year. They've seen stronger growth in earnings, but they've continued to get even cheaper. So I think that the rotation towards value that we've seen really driving the returns this year is likely to continue over the coming months. And then we'll get a bit more of a mix, really, between quality growth that will benefit eventually as interest rates come down and some of the more traditional areas that will benefit from a lot more CapEx spending into the next cycle.
Peter Oppenheimer, thank you so much for taking the time and bearing with us. Jack Manley and Mike Katopoulos will be sticking with us. Thank you to them as well. Joining us now with a look at the stocks moving ahead of the opening bell. Here's Abigail Doodle.
Well, Lisa, let's start out with today's big story stock. And that, of course, is Disney. Shares are soaring, in fact, heading to their best day since December of 2020, as into today, heading to the worst year on record since 1975. This, of course, in the news that the board is bringing Bob Iger back on for a 2-year stint as CEO. This after 40 years with Disney, 15 of those years, as you know, as CEO. His hand-picked replacement, Bob Chapek, is out, although I may add with $23 million. And his goal, Iger's, is to rein in spending on programming for streaming video, reignite growth for Disney+, plus bring in a permanent replacement. As for some of the weakness that we're seeing that are dragging on futures, Kaylee was talking about that zero COVID policy or the fears around COVID in China. Well, that's weighing also on the chip space. And earlier, Bitcoin was below $16,000 per Bitcoin, Lisa. That has some of the crypto stocks, including Coinbase, trading lower.
Abigail, thank you so much. Coming up, the Fed Speak Parade continuing ahead of Wednesday's minutes.
There is more work to be done. I expect that this will require additional increases in the federal funds rate, followed by a period of holding rates at a sufficiently restrictive level for some time.
That conversation coming up next on this holiday shortened week. This is Bloomberg.
We were thinking big from the beginning. I mean, the reason that I was interested in doing this in the first place was a much bigger challenge than making a comfortable shoe or doing something in the fashion industry as a narrow opportunity. We thought that there was a big leadership opportunity. We looked around at an industry where there was 20 billion pairs of sneakers made every single year, and it was 100% made from plastic and the hides from cows, and it was terrible for the environment. And we thought that we could offer something to consumers that was differentiated in the way it feels, more comfortable, higher performance, and do that because we use sustainable materials. And in doing so, we could take a really interesting leadership opportunity and grab that and use that to tell a totally different story and compete on a totally different vector than what the rest of the industry were doing.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
More work to be done. I expect that this will require additional increases in the federal funds rate, followed by a period of holding rates at a sufficiently restrictive level for some time. The latest data have not reduced my sense of what sufficiently restrictive may mean or my resolve to bring inflation down.
The message from the Federal Reserve fairly consistent. They are going to hike rates. They are going to keep them at an elevated rate for longer than perhaps the market can stand it. Back with us to understand what that means, Jack Manley of JP Morgan Asset Management, Michael Contopoulos of RB Advisors. Jack, you were talking before about how you do see long-term value. Perhaps it's not going to be in 6 months, but 12 months, 18 months, all of a sudden you do start to see upside for both bonds and stocks. Is there a shift, though, that you're seeing or you're making in terms of what the post-pandemic, post-distortion, post-inflationary environment market looks like versus what we got used to over the past couple of decades?
Yeah, Lisa, I mean, if I had to sort of sum it up in one clean sentence, it's this idea that growth at any price investing is dead. Or at least it's dead for as long as money's not free. And given where the Fed is going, given where we expect the Fed to land, and given where we expect the long-term trajectory of interest rates to take us, I don't think money's going to be free anytime soon. I think the Fed is desperate to avoid that. But on the flip side of this, Lisa, right, it's this idea that growth at a reasonable price investing is still very much an investment philosophy that is on the table. It is still a reasonable way to approach investing right now. And so ultimately, when I think about this sort of new normal post-COVID world of higher interest rates and challenged growth, we want to be looking for quality, and we want to be very active as investors right now. Index-based investing, I think, is just not going to cut it next year or even the year beyond that.
Do you think that index investing is dead, Jack?
No, I don't think it's dead, and I think when you look at what's gone on with multiples right now, given the fact that everything is on sale, as Peter mentioned earlier in his comments, I think there is a really nice beta tailwind that we will see in markets right now. But there is so much room for active outperformance with the right sector and security selection, frankly, with the right manager selection, that it makes sense to be an active manager right now in a way that it perhaps did not over the last few years.
Michael, what about in credit? You were talking about how private credit has seen perhaps an outsized number of defaults. How are we sure that the default cycle isn't going to be that deep in the public markets? How much conviction do you have around that?
I actually think credit is in a decent spot over the longer term. It's just sort of over the next 3 or 6 months, 9 months as the earnings recession takes hold and all of these hikes start to, be felt within the economy that they go through a rough patch. But on a whole, public credit markets are actually pretty healthy. I mean, if you stress interest rates, if you stress earnings down pretty hard, they still hold up reasonably well from a historical basis. So I'm not expecting a huge default rate here. A lot of the excesses have been wrung out of the markets over the last several years between the global financial crisis, followed by the energy crisis of 15, 16, and then, of course, COVID. And so I think default rates are likely to remain relatively muted, maybe get up towards 6-7% this cycle, in contrast to past cycles where you get up to, 10% plus. Spreads probably don't even near 1,000 basis points this cycle, but maybe go closer to 800 basis points. But that's a far cry from where we are today, and the path to get to those relatively low levels of defaults in spreads is going to be still quite painful. But there's going to be a great time, Lisa, where as a credit investor, and to Jack's point on active management, there's going to be a great time to go from interest rate risk to credit risk. That may happen, sometime early next year or by even mid or third quarter next year.
Michael Contopoulos, Jack Manley, both of you, thank you so much for taking the time. Happy Thanksgiving. And we will continue this conversation. Coming up, the morning calls, and later, Sylvia Jablonski of Defiance ETF staying the course amid investor pessimism. That conversation still ahead. And this just out, Brent crude falling below $85 for the first time since the end of September, perhaps on the China COVID shutdown kinds of discussions. From New York, this is Bloomberg.
Most of us don't spend much time thinking about the grid, the dizzyingly huge system of cables, transformers, and outlets that reliably powers our lives. It's an easily ignored, change-resistant part of the modern world, and that's the way we like it. But as we move towards less planet-melting ways of producing electricity, the grid is going to have to evolve too.
We're seeing so many countries and governments announcing high targets when it comes to decarbonization and being climate neutral. But this is just one side of the coin. It's not enough to simply generate green energy. We also need to make sure that this is transmitted and distributed to the end consumers.
The grid of today just isn't equipped for renewables. So a new kind of grid is starting to take shape. The supergrid.
When innovation strikes, Bloomberg Technology is there with the news and analysis you need. Every weekday, only on Bloomberg.
Countdown to the open. I'm Lisa Abramowitz in for Jonathan Farrow. A quick look at markets. We are seeing a bit of a down in stocks, and we are seeing oil prices go down. Time now for some of the morning calls. I'll look at some of the analyst recommendations on Wall Street this morning. First up, Argus downgrading Carvana to sell, saying the company will struggle to make a profit as used car prices continue dropping. Next up, SocGen downgrading ConocoPhillips to sell, seeing a little upside with shares trading at current levels. And finally, MoffettNathanson upgrading Disney to outperforming following the management shifts. Coming up, we'll talk about the gloom and doom clouding markets.
China's military power has been growing at an incredible speed over the last 20 years.
A strong country must have a strong military, as only then can it guarantee the security of the nation.
In terms of sphere of influence, we absolutely know that China wants to be dominant in Asia. So there is a target to get to that point, to be a military that is a peer to the greatest militaries in the world by 2035.
The competition for influence is a global one. And through a multi-decade trajectory fueled by planning, money, and pragmatism, China is building a military that allows it to shape the 21st century just as the U.S. shaped the 20th.
The top names in climate change are on Bloomberg.
Building out local wind, local solar, hydrogen, these are solutions to not just climate issues, but geopolitical issues. We are in a position by 2030 to have 80% of all electricity generated by wind.
Renewables are the safest, the cleanest, and the cheapest form of energy today, especially for countries such as Greece.
Nobody covers climate change like Bloomberg, your global business authority.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Countdown to the Close.
Welcome to Bloomberg Crypto.
This is Countdown to the Open. I'm Lisa Abramowitz in for Jonathan Farrow, just moments away from the opening bell. We could see that negative tone actually getting a little bit lesser of a negative as time goes on. NASDAQ down about 0.5%. The S&P down about 1/3%. You're seeing yields a little bit lower on the front end. Difficult to really get a sense in this holiday shortened week. I will say, though, Brent crude falling below $85 a barrel for the first time going back to September. You're seeing that play out in WTI down to 76.83, down about 4% today in the initial minutes of the opening bell. And the dollar, a little bit of dollar strength, reversing the dollar weakness, 102.51 for the euro versus the dollar. Joining us now with a look at the stocks moving at the opening bell, here's Abigail Doolittle.
Well, Lisa, as a result of that oil weakness, we do have energy as the worst sector on the day, and we'll be taking a look at one of those individual movers in a moment. But first, let's return to Disney, because these shares are soaring, the best day since December of 2020. This, of course, as Bob Iger comes back in as CEO. Bob Chapek is out, although I may add, with $23 million. And Iger's new task really is to rein in spending on programming for the streaming video, plus reignite the growth for Disney Plus, and find another new replacement, one who hopefully works out for a bit longer. This stock, I might add, into today had been on pace for its worst year, going all the way back to 1975, the worst year ever. As far as some of the other movers on the day, of course, with stocks down, we do have a number of laggards, including Amazon. Actually, Amazon has flipped higher, up 0.9%, really showing you that the intraday volatility that we've had all year is continuing. But this company, of course, has Black Friday either worry about, or who knows, maybe it will be a boon for them. ConocoPhillips, though, on oil falling. Brent crude, as you were mentioning, below $85 per barrel, down about 3%. U.S. steel also down 1%. This, of course, has to do with the COVID fears out of China, Lisa. China is the world's largest user of natural resources, so we have a lot of these materials and energy stocks down. And then Coinbase Global, it is off of its pre-market lows, but nonetheless down 1.4% earlier. As you know, Bitcoin back below $16,000 per Bitcoin, and of course still lots of questions and fear around the extent of the FTX bankruptcy and the fraud. What will it mean, that crisis in confidence for crypto?
Abigail, thank you so much. Sticking with Disney, chair of the board, Susan Arnold, writing, quote, "We've concluded that as Disney embarks on an increasingly complex period of industry transformation, Bob Iger is uniquely situated to lead the company through this pivotal period." Bloomberg's Ed Ludlow joining us right now with more. Ed.
Good morning, Lisa. Uniquely situated because he spent 4 decades at the company, 15 years as CEO. Many investors, and most on the sell side, are cheering this. You see that in the stock reaction, though it is surprising. Chapek only extended his contract by a 3-year period in July, and it was less than a year ago that Iger had retired from the executive chairman role. The big focus is the streaming business. The streaming losses for fiscal 22 were $4.5 billion, almost double what the company outlined it expected them to be at the beginning of fiscal 22. The problem is outlined in that chart, that the losses from the streaming business are outpacing the growth in revenue on the direct-to-consumer business. There is some feeling on the sell side, at least, that Chapek was not as focused or as ruthless on the bottom line as he could be, and Iger coming back will have that focus. His remit, as Abby said, is 2 years as CEO with a drive of new strategy while trying to seek a successor, but times are challenging. The stock down more than 40% year to date, on track for its worst annual decline since the 70s. The macro picture has changed, of course, but so has the industry and the environment for streaming. They've hung their hat on this streaming business, Lisa. The problem is business needs to be profitable, and there's a feeling actually Iger is the man to fix that.
Bloomberg's Ed Ludlow, thank you so much for that. Both Goldman and Morgan Stanley expecting a challenging year ahead for stocks. Morgan Stanley's Mike Wilson reiterating his view this morning, writing, quote, "What's yet to be priced is the earnings risk, and that is what ultimately will serve as the catalyst for the market to make new price lows in the first quarter." Bloomberg's Kaylee Lyons joining us now. Kaylee, what do you see?
Well, it may not be a whole new year, new me thing for this equity market, Lisa. If you listen not just to Morgan Stanley, but Goldman Sachs as well, which says the bear market is likely to persist through the duration of next year. They essentially think that at the end of 2023, we're going to be around 4,000, which is not much change from where we are now. Goldman says the conditions typically consistent with an equity trough just have not yet been reached, and therefore the recent gains we've seen aren't sustainable because stocks don't typically recover from troughs until you see the rate of deterioration in economic and earnings growth start to slow down. Now, Goldman's view isn't really far off from the consensus call for next year. At this point, the average strategist target in this month's survey has the index down at 39.31 come end of 2023. Although it's pretty telling, that's already 3% lower than they saw in the initial 2023 survey back in October. But clearly, the broad consensus is we won't be much change, which echoes the view of Mike Wilson at Morgan Stanley, which you mentioned, reiterating today that he thinks we will end next year near the current level, but it will be a bumpy ride to get there. He thinks we'll fall as low as 3,000 in the first quarter, which would be a 24% drop from Friday's close. As for what history suggests about whether a bearish call like that may actually come to fruition, the average peak to trough decline for the S&P 500 over the last 50 years of recession history has been about 37%. We were down 25% this time around before the recent rally on that cooler inflation data. So there's a 12 percentage point gap there from the norm. That could lend support to the idea that this bottom is not yet in, Lisa.
Bloomberg's Kaylee Lyons, thank you so much. So bearish that it becomes bullish. Defiance ETF, Sylvia Jablonski, seeing signs of a trough, writing, quote, "Stay the course, invest for the future. When people are this pessimistic and doomsday driven, it's likely a sign we are bottoming out." I am pleased to say Sylvia joins us now. So how strong is that conviction that you feel like, all right, people are so gloomy, so doomy, that's a screaming buy signal?
Hi, Lisa. So I don't think that it's necessarily a screaming buy signal in terms of a short-term, turnaround and major profit opportunity. But I do think that the market is going to kind of stay where it is. And even with the most bearish analyst that you just referenced, Mike Wilson and Goldman Sachs, talking about 4,000, that means that we get range-bound volatility probably between now and then. So you're going to get these bursts and perhaps these short-term opportunities. You'll get these pullbacks, but the market is unlikely to sort of fall, further out for the next year. What I think in terms of this market is that it's a great opportunity to dollar cost average in for those investors who have time horizons beyond 2023, because we talked about all of the things that haven't happened to really call a bottom in terms of earnings pulling back and that 37% move in the S&P. But what we're really also looking for is perhaps the positive things that could happen. So if inflation has peaked and it continues a downward trajectory and doesn't get stuck at 3 to 4%, that's a positive. If China reopens and COVID becomes a thing of the past, we keep sort of saying that, but it's still in our world, in our ecosystem here, that will be a positive for markets. We need a catalyst in either direction to get investors off of the sidelines. But in the short term, I do think you can pick your spots. For the longer term, names like tech, semiconductors, they are so far off 52-week highs that I just strongly believe that there's dollar cost averaging opportunities in those types of names.
One thing that Defiance ETFs does so well is thematic investing, and that's really one of the main spots for ETFs at this point when a lot of people are casting doubt on indexes in the face of the tech weakness. How much has tech clouded some of the valuation case made for other sectors that are being reflected into inflows into certain thematic ETFs that you oversee?
So that's a great question. I think the performance of tech has just led to this contagion in terms of any kind of higher growth, innovative, thematic ETF type of product. It's sort of shown up with crypto. Crypto has obviously gotten worse because of FTX in recent days, but anything that's sort of high growth and risk, it sort of makes sense because interest rates are a lot higher. You have a hawkish Fed, you have slower growth in the near term, so investors tend to pull back in those scenarios. But interestingly enough, we've started to see inflows into the funds in recent weeks, which leads us to believe that a lot of the sort of buyers and investors out there are thinking, okay, 5G, for example, we need 5G to communicate, to connect rural and urban America, for electric vehicles, artificial intelligence, and semiconductors are just notoriously hammered this year. Perhaps we are at a low in certain areas like that, and then that feeds the theme of sort of things like quantum computing, 5G, data learning. So you do see some bottom picking out there in thematics, and then thematics in different areas. For example, alternative energy, for example, are seeing great inflows. So we have a lot of interest in hydrogen, for example, and we're seeing investors looking to diversify their portfolio exposure in that way by picking up ETFs and single name stocks in that space.
So how much, Sylvia, you mentioned Bitcoin, and I know that Defiance ETFs also has some short Bitcoin and short crypto ETFs, and I'm wondering from your perspective, do you have any insight into why there hasn't been broader fallout? We were just speaking with Peter Scheer earlier this morning, and he was talking about the possibility of Bitcoin going below $10,000. I mean, how much is this something that you're seeing as a theme among the retailers and the institutions that use your funds?
So the way that we approach it is we look at companies that are related to the blockchain digital asset ecosystem. So not crypto itself, but names like MicroStrategy that hold a lot of crypto, or Coinbase that are impacted by crypto, Block, Galaxy, things like that. So these names are actually negatively impacted by crypto falling from 70,000 down to 16,000 where we are now, and perhaps if it goes to 10. So you might see a bid in shorting a lot of those types of names, whether through an ETF or individually, if crypto continues to fall. In terms of the broader market, though, I think it's sort of a good thing that the sort of crash of FTX isn't impacting Apple, for example, right? So it is this sort of unique, discrete asset class, and I think, look, you'll have traders that play both sides of this, right? I think a lot of investors strongly believe in the long-term future of blockchain technology, and so they'll scoop up some Bitcoin here because it'll be a payment method for Web3 and the build out of sort of all that. But in the near term, it's like any other short fund, right? When the market is falling and you have an opportunity to benefit from falling prices of stocks that relate to crypto, investors love it.
Sylvia Jablonski, thank you so much, and happy Thanksgiving. Coming up, Hightower's Patrick Frizzetti expecting more clarity around inflation to come next summer. More on that next. From New York, this is Bloomberg.
Lots happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
A lot of these areas still have very, very good valuations.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot.
We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
So now you've been at JP Morgan for about 25 years?
Yes.
Okay, so, and now you run one of the most important parts of JP Morgan, which, as I say, is the asset and wealth management business. What actually is wealth management, and how is that different than asset management?
Great question. The two are often used interchangeably, but they have distinctions. The asset management business is where we manage money on behalf of individuals, institutions, sovereign wealth funds, pension funds. We manage them in mutual funds, we manage them in ETFs, we manage them in single stocks, single bonds, hedge funds, private equity, and the like. And that is the heart of the fiduciary business that we run here at JP Morgan. Wealth management is that plus understanding someone's entire balance sheet. So for the individuals where we manage money, we also help them with their mortgage. We help them with a loan that they might need. We help them with their basic credit card. And so wealth management is trying to help someone with their entire life, both their assets and their liabilities, their planning, their gifting, the legacy that they want to leave for their families, the 529 plans they need to prepare to get their kids to go through college. And it's a great insight into people's, entire journey.
Welcome to the world of decentralized finance.
I'm going to take a look right here at regulation.
We are seeing digital currencies under some pressure.
Bloomberg's covering all things crypto. The people.
I want to have some of my money outside of the sovereign.
The transactions.
It all comes down to the details here.
And the technology.
How does that affect disruptors like you?
What happens to everything that you're investing in when the last Bitcoin is mined?
Bloomberg Crypto, Tuesdays.
Bloomberg Markets, the open, taking a look at the Fed speak this week. The Fed's Collins seeing another 75 basis point move on the table. Atlanta Fed President Raphael Bostic taking a less hawkish stance than his colleagues, saying over the weekend, quote, assuming the economy evolves as I expect in the coming weeks, I would be comfortable starting the move away from 75 basis point increases at the next meeting. Joining us now, I'm so pleased to say, is Bloomberg's Michael McKee. Mike.
Well, Lisa, this is the week of the Fed minutes, and a lot of people are going to be paying attention to that, but you probably don't need to, and here's why. The minutes reflect what the Fed was thinking back on November 2nd. And since then, as Lisa was just noting, an awful lot of Fed officials have been speaking. 6 of the 12 who will vote have said they're willing to step down from 75 to 50 if that's what the chairman would like. The chairman says so as well. And 6 more of the members of the 19 members of the committee have also said the same thing. Most of the rest have not spoken. And Collins didn't say she wants 75. She just says it's on the table. So what is a 3-week-old set of minutes going to tell us? Not a whole lot. Most of these Fed people have been saying they're still data dependent. They want to leave themselves with lots of room to make decisions based on the data, and a lot of data out this week because we're compressing it all ahead of the Thanksgiving holiday. Daily Messenger, George and Bullard, who've all taken a position speaking this week that Wednesday's the big day, probably want to look at jobless claims and the Michigan sentiment numbers about the idea of whether or not people think inflation expectations are going up. Then we've got those minutes. But the big news is going to be next week on the 30th, on Wednesday. Jay Powell is going to be speaking at the Brookings Institution, and he's going to be quizzed on monetary policy. So I think the minutes this Wednesday are probably not going to mean a whole lot if you've got Jay Powell 2 days ahead of the Fed blackout telling us what he thinks should happen and is likely to happen. So Lisa will keep an eye on that. That doesn't mean we won't carry the minutes or cover them. I'll be there, but,
for sure.
But this week may not be as important as next week.
Michael McKee, thank you very much. I do want to bring you this. Within the past 10 minutes, the Wall Street Journal has been reporting that Saudi Arabia and other OPEC oil producers are talking about actually increasing production of their output or increasing their output. And part of this could heal the issue that's come up with the Biden administration and also come ahead of additional sanctions on Russian oil. Some people speculating that this is what's behind some of the declines that we've seen in crude prices, with Brent falling below $85 a barrel for the first time since September. Meanwhile, we do have this feeling right now in markets that there is this disinflationary force. Perhaps this will add to it. And joining us to really parse through that is Patrick Frizzetti of Hightower right now. Patrick, thank you so much for being with us. How much are you seeing this disinflationary kind of move being borne out in the commodity sector on the heels of the expectation of weakness?
We've seen it now, I think, all year. I mean, the thing that I think the market doesn't totally appreciate yet is that, inflation is so pervasive that I don't see it going away anytime soon. I don't see us getting to a 3% inflation rate next year. I think this is going to be with us for years. And why that's important is, again, inflation in energy and consumer services, et cetera, as that ripples through, you're going to see markets, I think, continue to rotate. And what that means is we've had this change of leadership this year. We've seen it in commodities, yes. But we're going to continue to see that, I think, for the coming years. And so what worked, over the past 10 years, I don't think is going to work in an inflationary environment. So, the Fed has been very consistent in terms of, saying that perhaps that the pace of rate increase will go down, but the terminal rate will be higher. I think we're going to be stuck with this inflation issue for quite some time.
So how do you deal with the fact that you're seeing OPEC Plus respond, perhaps increasing their output, at least if this Wall Street Journal report is accurate that does cite sources? Patrick, how much do you sort of double down on your overweight of energy stocks, which we've seen outperform all year, even in the face of the countermeasures that are being taken around the world?
Take it in stride. This is a long-term move, and so these are always opportunities. To add exposure. If you're underweight right now, I definitely feel like, the energy market, and again, that rotation, energy just being such a small percentage of the overall market, up until, this year, and it's still very, relatively small. I think it's always an opportunity to use this volatility, on days like this.
Although we are seeing people say, okay, some of the areas that have gotten bid up most aren't necessarily going to look the most attractive in the next leg, simply from a valuation perspective, because we have seen such incredible valuation resets in certain areas. Is there anywhere in that space where you're starting to see something that's a little bit more attractive despite your hesitation in the face of further inflation?
Well, look, I would say in one area, say take media, for example, right? There's been such a divergence between valuations over the past couple of years with streaming. Disney obviously is at the forefront today, and Iger coming back into the fold, right? But when I look at media assets today, you're going to see, again, the corrections, continue to come through that space. And I think there could be, very good opportunities within that space. We have some exposure there. Again, it's sort of the value side of the equation when you look at part of the industry. And I think the growth side of the equation, at the other end of the spectrum. And of course, when you have, news coming out every day and, again, competition, I would say, among technology, I think that's a very important thing to pay attention to.
So given that you do see the inflation lasting a bit longer than people can stand it, and given the fact that Citigroup is talking about a 5.25% to 5.5% Fed funds rate, how much can you use bonds as the same kind of buffer, given that people are expecting a downturn? People do expect longer term things to reset back into some kind of normalcy that we've known.
I think bonds are a good complement for any portfolio right now. I mean, there is now competition for the equity space, and that's in bonds. And you can get a return with, I'd say, at least on the short end, with, relatively low volatility. And I think to have some exposure in bonds, I think for sure that's a part of any asset allocation, particularly, when you're looking a few years out. And so, again, it's because we haven't had these rates, for 12 years plus. And so that is something you really have to pay attention to, and really pay attention to when it comes to valuation of stocks, right? The discount rate has now gone up, right? And so now we see these valuations on the long end, particularly with these high growth companies, face massive corrections. And I still don't think we're done when it comes to some of those, previously high growth names in terms of correcting.
What will be the all clear signal for you, Patrick, to go in and start being more aggressive?
So, we look at signals all the time. I think, frankly, I said before that inflation is not going away. That's because the labor market is so strong. Companies still have a lot of pricing power, right? So when I start to hear companies, perhaps not having as much pricing power, or again, unemployment sort of rolling over, you start to see that move up significantly. Then perhaps, I'd see those signals where, okay, valuations have sort of reset and bottomed out, and we can add more exposure. But, I don't traffic in the index fund world. I traffic in individual stocks, and so I like to, do sort of the deep work with my research staff and create a portfolio that we think will, protect our clients and grow over the long term and take sort of a 3 to 5 year view.
Patrick Fursetti, thank you so much for being with us. Let's take a look at some of the sector price action this morning and head over to Bloomberg's Abigail Doolittle. Abigail, what do you see?
Well, Lisa, at this point, we're looking at a very small decline for the S&P 500 on extremely low volume. Most sectors are higher, but let's really hone in on energy, down 3.4%. Of course, you were talking about that report out of the Wall Street Journal that Saudi Arabia is discussing a possible OPEC increase. Brent crude below 75. WTI crude, Lisa, at its lowest level of the year. In fact, it's now breaking down. The question is, will that be good relative to inflation, or is that going to be a commodity collapse that will at some point weigh on stocks? We, of course, have the China news, COVID really weighing on the natural resources.
Abigail, thank you so much. Coming up, the market-moving events that you need to be watching. That's next in our trading diary. In the markets, you are seeing a bit of softness, although easing back with the S&P now just down 0.1%. We've got yields lower. So do we see oil. From New York, this is Bloomberg.
Go. After hardly a full year of name, image, and likeness deals being a reality, UCLA quarterback Chase Griffin already has more than 20 deals with major brands, venture, and charitable groups, all while balancing graduating undergrad in just 2 years and fighting for playing time on the field.
Chase Griffin out of the gun. We are joined by UCLA quarterback Chase Griffin. Not just UCLA quarterback, but name, image, likeness superstar. I am psyched for this one.
This kid could actually be the president of the United States someday.
When it comes to building generational wealth, it's not about the money that you make in college. I'm very excited that I made the amount of money that I made last year. I am even 10 times more excited that I know how to make that money.
When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
This is Bloomberg Markets, the open, a big move in oil that is just accelerating. And Brent, you're seeing it now below 83.3, $83.30, a fall of almost 5% after that Wall Street Journal story talking about the potential for an output increase from Saudi Arabia and OPEC Plus. Time now for the trading diary. We need to be watching this week. San Francisco Fed President Daly speaking at 1 p.m. Eastern. Fed Speak continues with Mester, Bullard, and George all on deck for Tuesday. Fed Minutes out Wednesday, followed by a host of data, including initial jobless claims, new home sales, U.S. PMIs, and the UMISH consumer sentiment. And finally, Thursday, it's Thanksgiving. From New York, this was Countdown to the Open. This is Bloomberg.
was interested in doing this in the first place was a much bigger challenge than making a comfortable shoe or doing something in the fashion industry as a narrow opportunity. We thought that there was a big leadership opportunity. We looked around at an industry where there was 20 billion pairs of sneakers made every single year, and it was 100% made from plastic and the hides from cows, and it was terrible for the environment. And we thought that we could offer something to consumers that was differentiated in the way it feels, more comfortable, higher performance, and do that because we use sustainable materials. And in doing so, we could take a really interesting leadership opportunity and grab that and use that to tell a totally different story and compete on a totally different vector than what the rest of the industry were doing.
Lisa, you've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question. Great question. Great question.
Great question.
Great question.
That's going to be the best question I get all night.
I'm glad you asked that.
Bloomberg Television. Top experts. Great questions.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Business Week about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands. And it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi-Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in sari stores every day, also on TV, radio, and newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number Fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. number fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with number fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the streets, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million-peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for number fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, Pepsi goons bomb their own trucks. And when I visited the MBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud, The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the number fever campaign. Del Fierro thought Pepsi's number fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees. But for people who couldn't afford the money, he would just represent them pro bono.
The alliance is to build up pressure on Pepsi. And so you see people marching in the streets. So we have mounted our own campaign, even in the U.S.
He flew to America and he hired two consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi-Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113, also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complication due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi number fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's number fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning $1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as a coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. And it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war, so the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund. Everyone is looking forward to it. The team always meets in the same hotel ahead of matches.
They stayed in this hotel in order to have a kind of neutral space before games so that they could concentrate, be sort of isolated from distractions, things like that.
Everyone was pretty optimistic they had a chance to go really far, maybe into the finals. I was in the office and getting ready for match day. I was going to meet with a friend, a fellow Dortmund supporter, in a pub. As always, the fans are very excited about matches.
On that day, they were heading to play in the quarterfinal against AS Monaco at Signal Iduna Stadium, which is in the center of Dortmund. Shortly before 7 p.m., the players of the team boarded their official team bus.
When the bus took off the parking lot of the hotel and turned on the street, there were three detonations, 3 bombs that exploded and hit the bus of Dortmund.
3 explosions occurred close to the Borussia Dortmund team bus. The B team bus had just left the hotel. The explosions destroyed 2 windows in the rear part of the bus.
People screamed, people jumped to the ground.
The fellow Dortmund fan I was supposed to watch the match with, he called me and said, turn on the TV, there was an attack on the Dortmund bus. And I thought he was like, that was impossible.
Some of the players screamed at the driver to keep driving as fast as possible because they were worried that people might storm the bus.
German investigators say the explosive devices used in the attack on the Borussia Dortmund bus contained metal pins, and that one had pierced a seat headrest.
Unbeknownst to the team members, the actual mastermind behind the attack was, as they were disembarking the bus, was actually eating steak and sweet potatoes at the hotel they had just left.
Authorities are attempting to verify a letter left at the scene claiming jihadists were behind the attack.
Because there had been a series of attacks by Islamic terrorists in Germany and Europe, there was widespread suspicion in the media that this was another Islamic terror attack. 3 letters were found at the site of the bombing that took credit for the attack on behalf of Islamic State. There were, however, reasons to doubt this particular narrative.
Would actually be a surprise if ISIS were actually part of this attack. Possibly could be employed by other groups like the far right wing to try and shift the blame.
The letters had some strange qualities. They were written in a strange German that used big, sophisticated words, but had basic grammar mistakes, as if someone was native German speaker but pretending to be a foreign person.
Federal investigators have detained 1 man suspected of links to Islamist terrorism, one of 2 suspects whose apartments were raided this morning.
Shortly after the bombing, a man in Austria named Rudolf, who was a big BVB fan, he noticed that something strange was going on the stock market related to the team's shares. He emailed the lawyers of BVB, who then forwarded that email on to investigators. The email stated that someone had bought 60,000 BVB put options, a wager that the value of the shares of the team would fall below a certain amount at a certain date.
Why would someone buy that ahead of a match and then 3 bombs go off? Something isn't right here.
For the person to make money off of that, it required the stock to go down quite a bit in a fairly short period of time. And it wouldn't just be the team losing a match, it would require something much bigger than that. There was another big red flag about this purchase, which is the fact that it had actually been made, number one, on the day of the bombing, but also from an IP address that had been traced to the actual hotel where the bombing had taken place.
When 3 explosions targeted the bus carrying the Borussia Dortmund footballers on April the 11th, written notes left at the scene claimed the attack was the work of ISIL. The truth, as is now alleged, is remarkable.
On April 21st, the police arrested a man in a southern German city called Tübingen. He was on his way to work, and his name was Sergei Benagold. He seemed like an unlikely suspect because he had no known connections to the Islamic terror world. He didn't seem like a far-right extremist. He didn't seem like a left-wing extremist either. He seemed to be a completely unremarkable young man.
A 28-year-old German-Russian man, named only as Sergei W., stayed in the same hotel as the players on the night before the bombing. He specifically requested an upper room overlooking the bushes where the explosive devices were hidden.
The media dissected why he would do that, what was his past.
He had been inspired by the 2015 terror attack in Paris. And he noticed that in the aftermath of the attack, the stocks of French companies went down. And he believed that if an attack took place that was directed at a specific company, that the decrease in stock price for that company would be even more dramatic.
It never occurred to anyone that someone would do that out of greed.
We now know that the suspect bought 3 different derivatives on the Borussia Dortmund shares. With all these derivatives, he bet on falling shares. The suspect bought the majority of these financial products on the 11th of April, the day of the attack.
If the plot had been completely successful and the stock had reached a value of 0, Benagold would have made up to 570,000 euros, or the equivalent of about $608,000. Ultimately, the plan completely backfired.
The attacker, Sergei Benagold, didn't make any money. In fact, he lost money.
In court, he would be extremely quiet. He usually kept his hands clasped together. One of the lawyers actually commented that he had never seen a defendant act so calmly. Benagold had served some time in the German military. From that information and from online research, he was able to figure out how to assemble remote detonated bombs that would do what he hoped to do. There were a few days of extremely emotional testimony, including the soccer players who described doubting whether or not they could ever play another game again.
It brought everything back up, and it didn't quite help them to kind of process what was going on.
Throughout it all, he sat there completely silent. The big mystery that was swirling around the trial was the question of why. He may have simply done it because he wanted to impress a woman. Rebecca is a young woman who has a very troubled home life. She ultimately sees her relationship with Weinergold as an opportunity to leave that troubled home. Weinergold is a Russian immigrant to Germany. He speaks with an accent. He has anxiety in large groups of Germans. She begins to resent the fact that he has these fears and feels a little bit trapped. Rebecca attempts to dump him on multiple occasions, and he threatens to commit suicide if she leaves him. Weinergold apparently told Rebecca that she would soon be seeing a surprise. After being dumped via text message, he apparently began planning for this attack in earnest. Weinergold was charged with 28 counts of attempted murder, which carried a maximum sentence in Germany of life in prison. He claimed that he had nothing to do with the attack, but as time went on, he admitted that he had actually been the person who had built the explosives and had set them off. But he claimed that he didn't want to actually kill anybody. Ultimately, Weinergold didn't receive the harshest possible sentence. He was given 14 years in prison, but it's still a considerable amount in jail in Germany.
The threat of an asteroid hitting Earth is very real. If it's big enough, it's also very final.
These are very, very infrequent events. The probability is not zero, though.
A blinding flash of light streaking across the sky.
About 100 tons of space rock falls on Earth every day. Most of it is so small it burns up in our atmosphere or lands unnoticed away from major populations. No human in the past 1,000 years is known to have been killed by a meteorite, and according to NASA, no large object is likely to strike the Earth any time in the next several hundred years. However, one thing is certain: we haven't found them all.
There are thousands out there, and we don't know where they are.
There are a lot of asteroids in our solar system. They number in the billions.
Scientists all over the world are working toward detecting and deflecting the most catastrophic of natural disasters.
The race is on to find as many of these objects as we can.
We have a way of calculating whether or not an asteroid is potentially dangerous or not.
I mean, I think it's something worth investing in. It's our existence at stake, right?
Amy, let's get this one out of the way. It's probably the question you get asked the most, but how scared should we be?
Asteroids and comets are a natural hazard that's out there like a lot of other natural hazards. These are very, very infrequent events, these collision events, where an object actually impacts the Earth. The most important thing that we need to know about asteroids is when the next impact is going to happen and how bad it will be. What we know is that an object that's about, say, a kilometer across is capable of causing very, very wide devastation across the planet, really, truly global devastation. The object that wiped out the dinosaurs was somewhere in the neighborhood of 5 to 10 kilometers across, so even bigger than that. At a kilometer, it's still going to be very bad and will have global effects. For objects that are capable of causing what I would call sort of regional damage, kind of a large major metropolitan area, a city and its surrounding environment, sort of around 100-ish meters. It depends on the details of the composition and so forth.
By the 1980s, NASA was cataloguing near-Earth objects. In 1994, stargazers watched as comet Shoemaker-Levy 9 hit Jupiter. The resulting zone of chaos was estimated to be as large as the Earth, and the event became a turning point in the search for asteroids and comets in our solar system. In 1998, Congress tasked NASA with finding 90% of asteroids and comets 1 kilometer wide or larger. Soon after, Hollywood blockbusters Armageddon and Deep Impact brought attention and fear to the masses.
The great news is that the vast majority, more than 90% of all the really large 1 kilometer near-Earth objects have been found. The challenge now is working down to these smaller sizes that are still quite capable of causing a lot of damage, but they're just harder to spot because they're fainter, they're smaller.
Can you give us a sense of how many are out there in our solar system?
We know that there are a lot of asteroids in our solar system. They number in the billions. Most of them, however, are between Mars and Jupiter in what we call the main asteroid belt. This is a region of space where most of the asteroids in the inner part of our solar system live, and they stay there for many billions of years. There is another population, though, that kind of leaks inward and gets into the region somewhat close to the Earth, and we call these near-Earth objects. We think that there are millions and millions of near-Earth objects that are out there in the total population. As of today, we know of sort of around 20, 25,000, something like that. When we first spot an object, we really know very little about it. We just see something moving across the sky. So all you get is just sort of a handful of snapshots, just enough to be able to tell that this isn't an asteroid that we've already seen before. And then once we can calculate the distance to it, we can now start to make predictions about its true size. Is it large or is it small? So we have a lot of information that we have to get pretty quickly to really understand what's going on.
Finding asteroids is just one piece of the puzzle. Planetary scientists are extremely skilled in determining the orbits and speeds of asteroids based on relatively small amounts of data. NASA runs simulations of the trajectories asteroids could take, which is useful but time-consuming. A team of scientists in the Netherlands have found a way that could buy us more time.
Our method is very quick. So you can very quickly get an assessment of whether or not the object is dangerous or not. If you look at the classical way of determining the danger of an asteroid, it may take days of computing time on very big machines to determine this hazardousness.
The current problem is that there's just too many asteroids out there to spend a huge amount of computational power on all of them. So the neural network allows us to focus on what really could go and pose a hazard to Earth.
A neural network is a computing system that mimics the way the human brain operates to find underlying relationships in a set of data.
By training the network in this way, you train it in recognizing those objects that are most likely to hit the planet. And once it's trained, you can apply this network to all the unknown asteroids. And then you can make a selection and saying, hey, these are the ones which appear to be having orbits similar to the ones which we know